The interest rate ought to balance the supply of savings against the demand for capital. That's what the interest rate should be. It should be set in the free market, full stop. But of course, what we have is a bank and government cartel that sets it. And that's why we have all these problems. I mean, look at it, Adam. You have 0% interest rates, which makes everybody who can borrow wealthy, or you have 20% interest rates that almost banked my dad in 1980 when we were eating tuna fish sandwiches for dinner for weeks on end. I mean, it's just, it's kind of it's just an up and down system that's very painful because it's run by a cartel that is, the banks and the governments.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. In my opinion, the easiest macro trend to forecast is that our fiat currencies will continue to lose purchasing power in the years ahead, likely at an accelerating rate. Today's guest not only agrees, but rings that same bell even more loudly than I do. For an update on his outlook for inflation, asset prices, the economy, the dollar, and what to expect next in this current fourth turning, we're fortunate to welcome back to the program investor and sound money advocate Lawrence Lepard, author of the book, The Big Print, What Happened to America and How Sound Money Will Fix It. Lawrence, thanks so much for joining us today.
Good to be back with you, Adam, and I really enjoy you and your show. So looking forward to this.
Well, right back at you. This is your second appearance on the show. Your first one got a lot of great feedback, Lawrence. So looking forward to doing this on a regular basis with you. First off, too, I want to thank you. We're recording this on Labor Day. You're letting me ruin your Labor Day festivities here. I had some schedule rejiggering this week, and you were kind enough to be flexible to record today. So thank you very much. Look, you got a lot of questions here for you, but you have done me the kindness of watching a couple of my recent videos, one with Lacy Hunt and one with Steve Hanke, both of whom are predicting disinflation in the case of Hanke, or really outright deflation in the case of Lacy. And I think there's some things that they've said that you agree with, and there might be some things that they said that maybe you have a different opinion on. So can we start from
I love because I thought they were two of your really best interviews recently, and I learned a lot, and I like both gentlemen a lot, have a lot of respect for both gentlemen, although in Hanke's case, I'm not real wild about his view on Bitcoin, but we'll set that aside. He started working in 1970, so it's harder for older folks sometimes to get it. Let's start with Hanke. I mean, and I understand that just the whole notion that we could have disinflation or deflation. I mean, yes, of course, when you build up a lot of debt and you get way out over your skis, you're bringing consumption forward, and so that debt, if it starts to unwind, that's a deflationary event. I mean, a perfect example of this was in 1929. There was a ton of debt, there was a ton of growth, there was a huge bubble, and as it unwound, we had massive deflation. So don't get me wrong, it's not as if we have to have inflation forever, and in fact, deflation usually follows massive inflations. However, we've got to consider the policy response, and we'll get to that in just a minute. But let's look at Hanke. I thought what he said was extremely interesting. Where I really kind of disagree that we could have a disinflationary period, where I really kind of disagreed with him was partly how he's measuring inflation. We all know that the numbers are not really true. And I think he kind of accepts what they tell us as the accurate numbers. And I think you have to kind of read outside the box and realize that no, that the numbers they're reporting aren't true. But even for the sake of argument, let's say they are true. He said something in his interview with you that I just found kind of stunning, and I disagreed strongly with, where he said, well, yes, I mean, we need, money supply right now is growing at between 4.2 and 4.6%. And if you look at that, Bilello just had some great charts that he sent out, shows, M2 has now hit a record high and it's growing at 4.8%, he says. And Hanke said, well, look, it's growing at this rate, but that's not fast enough to keep, the 2% inflation mandate. He made the point and said, he believes that M2 needs to grow at 6% to have the inflation target of 2% get hit. And yes, my brain kind of exploded when I heard that, because I was just like, hang on a second. M2 by definition is the underlying definition of inflation. Now, of course, it shows up in different places at different times at different speeds. I mean, insurance costs are high right now. I mean, look, inflation is not an even thing. And then he went on to say, well, yeah, notice how, we took rates down to zero and post the GFC. And, we had a problem keeping inflation at 1 or 2%. And I was like, well, yeah, dude, but look at asset inflation during that time frame. You had this enormous carried interest bubble that got built, in all the assets. So I kind of disagree with his notion. I mean, I tend to be much more of a hardcore monetarist in the belief that, in the long run, if you look over 50 years, M2 has grown at 7%, and that's the underlying rate of inflation. Now, CPI is going to go up and down. There are all kinds of different things that occur. As we know, COVID drove it up to 9, and then, Powell shrinking the money supply by 4.7% brought it back down to, well, we kind of briefly got it stated at 3, but whether it's there or not, it's open for debate. But anyway, that's it on Hanke. I mean, just to kind of summarize.
And sorry, let me just clarify one thing.
Sure.
So from your tone, you you don't place a lot of faith in the official CPI numbers because
Correct.
you suspect they are higher. I just want to make sure that's clear.
That's exactly right. I mean,
Yeah.
and I think most people listening to this would just have to agree. I mean, we are not experiencing 3% inflation today year on year. I mean, I can point to numerous categories where we're well over 3. In fact, this morning I tweeted a chart on electricity prices, average electricity prices throughout the United States, and they're going up at a lot faster than 3% a year. I can tell you that. Now, part of that's based on the AI demand and what I call the AI bubble, and we can get to that later. But and so that's a different matter. That's not necessarily M2 inflation. That's demand-driven inflation. But yes, you're right. I think the inflation numbers are misstated. And more importantly, I really wished in that interview, and I'm sure you can't always interrupt these guys when they're talking. I was kind of like, come on, Adam, ask him how the heck he gets to 2% growth inflation with 6% money supply growth. I mean, that's a disconnect in my mind anyway. So let's go to Lacy, who is obviously, as you said in your thing, is one of our best economists, a brilliant guy, tons of respect for him. And he made 2 points, and I'm going to disagree with the first one. I'm going to agree with the second one. The first point he made was that he thought we were in kind of a fiscally balanced situation. And he said that, they were doing the accounting on the big, beautiful bill incorrectly, and that therefore he didn't actually think deficits were going to grow the way the Congressional Budget Office and others say they're going to grow. And I would push back on that. My observation is, one, if you look at the last few months, I mean, first of all, tariff revenue is good, right? And he said we were going to get 300 plus billion of tariff revenue. I'm not so sure about that. It looks like we're getting about 20 billion a month. So that annualizes out to 240 billion.
Yeah. Although, just so you know,
yeah.
Secretary Bessent has, I think as recently as like yesterday, said he was thinking more 300 billion and is now saying it could be substantially more than that. So
it might be. It might be.
They got to show us.
Yeah,
we get to be Missourians here and say,
yeah, we don't know. Yeah,
show
show me. I mean, well, and as Hanke, or I mean, as Lacy pointed out, there's a second and third round. Maybe they increase. I mean, we don't know. Right now, what we do know, last couple of months, we've gotten about 20 billion more per month in tariff revenue. That's good. I mean, that helps balance the budget. The flip of that is that they did the big, beautiful bill, and it depends on how you look at it, how you score it. And look, Lacy's probably forgotten more about economics and being an economist than I know. But I do know that, what I read and what I see would indicate that there are some people who say that it's at least a $200 or $300 billion in excess spending as a result of the big, beautiful bill. And arguably it could be 400, 500, 600. I mean, that's admittedly out there a bit. But my point is, there doesn't seem to be, from what I can see, a lot of evidence that the fiscal situation is getting better. He claims he thinks it's neutral to flat. And furthermore, if what he's right, what we're going to talk about in his second point is correct, and the economy does slow down, that's not going to help either, because a slower economy, a slower growth in stock market, all of those kinds of things, they hit the revenue side.
Mm-hmm.
And then some of the safety, measures get hit, and unemployment and stuff, and the costs go up. I mean, as we do know, in 08 and 2000, we had those 2 big downturns. I mean, the deficit went up, like 6% and 8% respectively as a percentage of GDP. So if we get a big economic slowdown, which we're coming to in his second point, then the deficit's going to get worse. So I guess my belief is that the deficit's really a mess, and I don't see any evidence that DC is really dealing with it. In fact, more recently, I mean, and God bless him. I mean, there's a lot of things I like about Trump, and some things I don't like about Trump. I mean, Trump's talking about, well, we're getting all this tariff revenue. Maybe we should send out a tariff dividend. I'm like, dude, what are you talking about? We're running these enormous deficits. You finally start to get closer to balancing the budget, and you're going to give back the money that we got as tariff income? I mean, come on, that's just not going to help the problem. So, but let's move to Lacy's second point, which I thought was really insightful and brilliant, and I hadn't fully thought through the implications of it. And that is that kind of the Charles Kindleberger argument about what happened when the last time we really did tariffs in the 20s and 30s,
mm-hmm.
And the whole Smoot-Hawley. And as it looks like, in fact, it was Hanke who said, Yale says our tariffs are running about 18%. And, it's interesting, the Smoot-Hawley tariffs were about 19.7%. So we're kind of right where they were on an average today. And Lacy said, hey, look, hang on a second. This is a tax. This is going to slow down demand. This is going to slow down the economy. This means that, our trade deficit's not going to be as large, which means that their account surpluses aren't going to be as large. Their account surpluses get invested in our markets. They're not going to do as much of that. Oh, and by the way, the fact that the dollar is going down isn't going to help part of why we've been able to maintain the sound markets we've been able to maintain is that the dollar had been strong. And so a foreign investor could come put their money in our stock market. And then when they came back to their native currency, if the dollar hadn't moved, they had a gain. Well, if they put money in our stock market, our market goes up 10%, but the value of the dollar goes down 10% against their currency, they're net break even. So that's another reason why, I think our markets are kind of teetering on the edge of having a real accident. And I know you've had some other guests on that talked about that. I'm not really, I've kind of given up being a bear on the stock market. It's been such a frustrating experience. I've lost a lot of money behind puts, and but I do know it's not cheap. So, but I guess, so the point that he went on to make that I thought was so insightful was that these tariffs are going to slow things down and they're going to make a mess. And most people aren't really thinking that through. And I have to agree with him. But here's the part he didn't follow through on. And my next conclusion is, okay, that's probably right. But tell me about the policy response.
Right.
And that's the point of my book, right?
Well, and this was my question for you is I actually think you and Lacy maybe see the world pretty similarly.
Yeah.
It's just that when we get into this Kindleberger spiral that he's concerned about, that opens the door to the next step of the big print.
Yeah, and so, but I was fascinated. Weren't you fascinated to hear that Lacy thinks the Fed is too restrictive and should go down 100 basis points? I was fascinated to hear that. Right?
I was, except he had said something similar the last time I'd interviewed him, so I was prepared for that. Yeah.
Yeah, I had missed that, but I'm kind of like, wow. Who thought he would be talking Trump's book? And as he said, he thought about it before Trump came through with his 300 basis point cut. But anyway, so I think he makes a really great point, which is that these tariffs are going to slow things down, and that is going to have an impact on liquidity, on the markets, on everything else. And so I think we're eventually headed towards some kind of an accident or a problem where the Fed is once again deeply backed into a corner. And I think Trump actually is correct. They are too late. They're damned if they do and they're damned if they don't, because they really don't have inflation under control. We all know that. And yet, but given the debt burden, given the cost, and given the fiscal emergency, and I really do call it that. I think we are in a fiscal emergency, with interest rates going up as rapidly as they have, and interest expense going up as rapidly as it has. They've got to get that interest expense down, Adam. They've just got to, or something's going to break. And it's there's some signals it's breaking. You can kind of see it in the 30-year Japanese bond. You can kind of see it in the 30-year UK gilt.
Yeah.
The French
Though
bond.
You can't see it in U.S. credit spreads.
No, isn't it amazing? U.S. credit spreads are tight as can be, and the 10-year's hung right in there. It's now, but to be fair, on the 10-year, Besant has been doing what Groman calls, kind of shadow QE twist, which is to say, he's been selling short-term bonds and then using the proceeds to buy the longer stuff, right? So he doesn't want so the real important thing that's going to come up here, and actually my partner pointed this out to me this morning, is okay, so they're going to take rates down. Then what happens to the U.S. 10-year? I've really kind of got my eyes peeled on the U.S. 10-year. We know if it goes above 5%, they've got a problem, because we saw that happen in September 2023 and they panicked.
Right.
12 Fed governors talking about how the rate hike cycle is over. So to me, if the 10-year takes out 5, we're all the way in it. And I think we're probably pretty close to all the way in it based on the recent price action in silver and gold, literally as recently as last week and this weekend. As you know, silver is now through $40, which is enormous overhead resistance. 20 or 30-year overhead resistance. And, gold is now broken out of a big bull flag at 3,500. Bitcoin has not followed yet. I got some interesting data on that if you want to discuss it. But, to me, it's kind of like we're in it, in my view. And, I definitely noticed in the portfolio I manage, all the gold stocks I'm involved with and you mentioned earlier, I think in another video, you said how you'd had your first, 10 bag or something, one of your gold stocks. We've had some of that too. It's crazy, right? And so to me, what's happening is the world is waking up to this problem of fiscal dominance, the problem that the government can really only solve it by printing money. And that debasement, yes, it's bad, and guess what? It might get worse. And to me, that's the biggest thing. When I listen to all these podcasts, the thing that I feel like enough people aren't screaming about is how bad the inflation is going to get. I mean, I've got some data points. The last time we had yield curve control was right after World War II, and they were dealing with 130% debt to GDP at that time. And the Fed had locked in the short rate at 3/8 and the long rate at 2.5%. And this all was before the Treasury Court in 51 when they changed it. But in like 47 and 51, they had one month where inflation was year on year up 17%. They had another month where year on year it was up 21%. I mean, these were eye-peeling inflation numbers. That was all because they were doing yield curve control. They were holding those rates low. The only way they could hold those rates low was to print the money and expand M2, and it grew massively. And then that led to inflation. And I was kind of like, okay, this is going to rhyme. I can see where this is going, so we're not there yet, but it feels to me like we're very close to the edge on that.
So a couple of things. So I'm right there with you, and I do want to talk about the action that's going on in gold and silver and Bitcoin. And as I said in the intro, look, haven't done a ton of these interviews, right? There's a lot of things that I can put on a spectrum of probability.
Yeah.
But the thing I can put the furthest to my high confidence part of the spectrum is that the purchasing power of fiat currencies is going to continue to go down, right? For all the reasons you wrote about in your book, and you've mentioned a number of them here. Now, the question is, what's the path between now and then going to look like, right? And guys like you and I, Larry, we got into gold and silver a long time ago because we saw this risk. You got into Bitcoin. I personally haven't really gotten into it that much. And, yes, do I wish I had bought it back in 2013 when I interviewed the data architect behind Bitcoin? Absolutely, but I didn't. But gold and silver, between 2013 and 2 years ago, it was a rough slog, right? So
tell me about it. I mean, I detail that in my book. I mean, I tweeted the other day about how, meet with triumph and disaster, Kipling. I mean, in 2015, I mean, I was broken. I was a broken investor. I really was. And I converted religiously. And I mean, I went and I sat there and I thought to myself, well, there's got to be a higher plan here. And I'm just going to hang on because I think I'm right about this stuff. And there's no going back. So yeah. And by the way, that's kind of happened to some people in Bitcoin too. I mean, remember, Bitcoin's not a free ride. If you bought it at Sam Bankman-Fried peak of 65, it went to 15. There are a lot of people who did that, and when it went to 15, they thought they'd made a mistake. And even
they
today,
jumped out, yeah.
Yeah, even today, I always tell people when they're looking to buy it, I say, you do realize this can go down 50%. I mean, you got to be ready for that, and you got to realize that if that were to happen, you would want to be thinking about buying, not selling, and thinking you made a mistake. Because as a good friend of mine, George Bodine, puts out in his one tweet he put out recently, if you hold Bitcoin, if you hold it for 4 years or more, you've always been in a profit historically. But a lot can happen in that 4 years. The volatility of those drawdowns is no fun. I can assure you, I was there.
Right. So that's my point here, which is, you can have really high confidence in the outcome, but the path might kill you 6 ways to Sunday if you put all your chips on that outcome.
Absolutely.
Right?
Have you ever seen Dan Murmacan's chart, his Weimar chart, the gold marks with
gold,
the red, a brilliant chart. Dan's a great guy, great monetary scholar, and I mean, these monetary events are confusing and volatile, and leverage is not your friend. You gotta know what you own. You gotta know why you own it. And the reason I own gold and silver and Bitcoin is I believe they are all forms of money, and I know for a fact the government cannot print them. And so, what happens on the price day to day? I mean, there are plenty of people who beat me up for poor performance and in a down cycle. And I recommended Bitcoin at the New Orleans Gold Show, at 50, and it went to 15, and I got a lot of angry calls. And I just said, well, you got to wait. I mean, I invest in a 5-10 year window. I mean, I look at longer term. I'm much more concerned with being right longer term than with being right in a 6 month or a 1 year window.
Okay, so totally agree. Though, again, the point I wanted to sort of stress for folks is it's probably going to be a wild ride no matter what happens, but you've got to be an active manager on this. And if you decide just to put it all on your high confidence outcome in the long run, that's your choice. Just know that it could be a real bruising ride between now and then.
Well, Correct. But the point of the book, by the way, just to reemphasize, was that I still think that if you look at, and I don't know exactly who your audience is, but I know it's huge, and I think it's a lot of everyday investors in America, and I still think a very large percentage of that base just owns a lot of stocks.
Oh,
And
absolutely.
yeah, and does not own a lot of this stuff, does not own a lot of Bitcoin, does not own a lot of gold, does not own a lot of silver. And I really tried to write the book as a wake-up call to that base of people and say, hey guys, this monetary debasement thing is real. It's a trend. It's going to last multi-years, maybe decades. And, at least for a while, you have got to have 10, 20, 30% of your assets over in this bet, because if you're all stocks, that's just not the right allocation. That's what I was trying to say.
So, and I agree with that. I think the book does a really good job of making that argument. You're largely right about this audience. I would say, like everybody, I mean, right now the retail investor has more exposure to stock than they ever have, and
Right.
scarily, the population of retirees, the oldest
Well, that's
population,
right. The
has their
boomers.
highest exposure.
I look at all my friends and neighbors, and they're all and they're feeling great because they've had a bunch of great years, and they've been very heavily trained to buy the dip. I mean, since 2008, if you bought the dip, you're looking good, even as recently as this year. I mean, Liberation Day happens, wacko, we're down 10, 12% really fast. But, if you bought it, you're feeling okay today.
Right, and I wonder, and this might be a question for later in the discussion. Is that cohort just whistling past the graveyard here, and kind of on a collision course? I think you would think probably so, but
I think they are, but I could be wrong. I mean, I've been wrong before.
yeah. Well, so where I'm going with this is, again, we may have confidence in the outline, but the path between here and there is inherently unknowable.
Right.
But we can probably have some confidence it's going to have some big twists and turns, right? And
Yeah.
so Lacy, again, I don't want to speak for him, but I'll do my best interpretation, which is, he's very concerned by the debt overhang, as you are, right?
Yeah.
And I mean, at the end of the day, unless you can get this economy to sustainably grow at much higher rates, which I don't think anybody really sees happening, we don't have that visible hope on the radar yet. It looks like we are hurtling towards a default, and it will either be a default of um, choice, where we just say, hey, look, these debts are going to go bad, and we're going to let the borrowers take their lumps. That is not generally how things go with the way the show is run. We generally default by printing, and that just, we pay back the debts nominally, but to do so, we basically reduce or destroy the purchasing power of the currency. So when I talk to Lacy, I see him being very concerned about the debt problem. He is concerned about the level of fiscal spending. If it didn't come across as much, I mean, it's still something he's very concerned about. And I just think in the near term, he thinks, look, this economy is at risk of slowing much faster than is conventionally appreciated right now. And
I share that view.
yeah, and so that could, Larry, I'm not saying it was, but I'd like to get your thoughts on this. That really could take the inflation worries away in the near term, right? Inflationary impacts of tariffs. So there's people who think tariffs could still be inflationary, even though Lacy says evidence is they actually are deflationary because they reduce liquidity. So we could go through a period, even a recession, where inflation gets taken off the table as an immediate worry, right? And now all of a sudden we're all worried because companies are firing people and nobody has jobs and that type of stuff, right? Doesn't mean that we should take our eye off the ball from purchasing power, reduction in purchasing power because of your big print expectation, right? So all I'm going with this on this is right now I interview a lot of people, and where they see inflation going and bond yields going in the next 12 months is probably the single greatest area of disparity in experts' outlook. Something we think we're stuck in a new inflationary cycle, and it's only going to go up from here, and tariffs are going to make it worse, and bond yields are going to be stickier. They're going to keep going up no matter what the Fed does. Others like Lacy, I think, you know what, deflation is going to win this battle in the near term, or near to midterm, next 12 plus months.
I think that's possible. I mean, I think one of the things that he's probably banking on is the notion that even if the Fed does all the inflationary things I'm talking about, it won't matter. This bubble is so damn big that, that there will be no demand for anything. And if demand goes down a lot, prices do fall. That is
Yeah.
deflation.
And I think that's why he's saying he thinks the
Yeah,
Fed should be cutting 100 points
that's,
right now. Yeah.
yeah, that's certainly a tail case for me. And I don't discount that. I still think that even in that tail case, I know on a relative basis, gold, silver, and Bitcoin will hold up well compared to stocks, and probably okay compared to bonds. I mean, there won't be necessarily, I mean, yields could fall, but again, I think the policy response will be so massive and so aggressive, and they tested it with COVID. As you saw, I mean, they just created so much money so fast. We've now got the concept of stimmy checks out there. So
Yeah,
we now
direct
we
payments to
now know how to
households.
wire money directly to people. You
Yeah.
know, the PPP gave trillions of dollars to businesses. I mean, as Ben Bernanke famously said, we have a technology called a printing press, and we can stop deflation from happening. And whatever it might take, I think they will view deflation, hardcore deflation, as an existential threat, and they'll behave in a way. The policy response will be so aggressive that the outcome will be inflation. That's my belief. Now, I could be wrong about that. It also depends upon the politics of it all. I mean, we've got a Trump administration, and I found it fascinating. I was just interviewed by Michelle McCory, and she showed me an ad that Eric Trump was running for gold, and gold-backed investments. I think he's being paid by the company, and he said, my dad's a big, fan of sound money and gold. And I was like, wow. And we've heard Trump say things like, he who has the gold makes the rules.
Mm-hmm.
And we've heard Andy Schectman and others, and I agree with them, say, all these gold imports this year might have been refilling Fort Knox. And I have an old friend who knew some of the Treasury officials, now dead, in the Johnson administration. I think Fort Knox was drained when they supported the London gold pool in the 60s. That's my thesis. And we don't have all the gold that we say we have there, but I think they're trying to refill it.
Well, and when the French were, taking their gold,
And when the French were taking all this stuff out, exactly. And so, yeah, I mean, it's the right area to be debating, and I don't think any of us know. And I think one of the reasons we really don't know is we don't know what the government's going to do. We don't know exactly what the policy response will be. And what I've done is I've mapped, the last 15 or 20 years of policy responses. And, you're a politician, your choice is let the entire world collapse, and, we're fighting in the streets and the ATMs don't work, or you're going to print the money. Pick one. And
yeah, well,
they're always going to print the money.
Yeah,
Right?
and let me interject this, because your book does a great job of making the historical argument for why we should expect more of that going forward.
Right.
And I actually think we don't even need to get to that level of sort of existential threat before elements of the big print start kicking in. I think Lacy could be, and look, this it doesn't matter what my opinion is, but the Lacys of the world think that, hey, look, the sledding is going to get tougher economically in the near term as these forces of deflation or Hanke's disinflation take over in the near term. But if and when it gets to the point where we start seeing some real pain, the central planners are going to step into rescue mode, right? And we don't even necessarily need to go into recession. I just think if bond yields, to your point, if they start going up to 5, right? The Fed hasn't said this publicly. I've heard a lot of people who talk to the Fed say, QE is going to be kind of politically tough for the Fed to ramp up again, because it really kind of became appreciated that it really just, more than anything else, just drove wealth disparity. Yeah. But at the end of the day, this government has to fund itself, right? Yeah. And if it starts really compromising the U.S. government's ability to fund itself, I think they're going to go back to QE. I think the odds of them going back to QE
well, yes, and
fairly decent.
I think, yeah, I agree with you. I think it's interesting though. They're going to dress it up. They're going to create, in my opinion, and this is just a guess. I don't know anything, but you have to speculate if you're making bets on this stuff. And my speculation, they're going to use the banks to do it. They're going to go to the banks and give the bank, and they're going to use foreign banks as well. Yeah. They're going to say, I mean, what if they went to the JGB, the Japanese central bank, and said, guys, we're going to give you an unlimited swap line at 50 basis points, but you got to use the proceeds to buy the 10-year. Mm-hmm. Right? I mean, and they could do that, right? And they can do the same thing with the U.S. banks. Guys, we're going to take away all the SL, the supplementary leverage ratios, all the restrictions, all of it. It's all gone. You have to buy the treasuries. Oh, you don't have enough capital to do it? Fine. the new lending rate for the Treasury purchase program that we've just initiated is X. And by the way, X is below, the Y, which is the Treasury yield. I mean, frankly, it's in my book. This is what happened in World War I. I mean, it was brilliant. What they did was, Liberty bonds. Remember, they were selling in World War I. They had to, support the war, be patriotic, buy Liberty bonds, 3.5%. Then they went to the banks and said, guess what? You can borrow from us at 3%. And the banks were like, we can? And they were like, yeah, this is, and they said, okay, we know how this works. We're going to borrow from you at 3%. We're going to buy the Liberty bonds at 3.5%. We're going to get 50 basis points free, because there's no risk, right? And that's what they did. And that's how they grew their balance sheet. That's how they financed the war. I mean, this is kind of the evil partnership that we've got between the government and the Fed, where, the Fed gets to keep the system going and the government gets the things they want paid for, right?
Yeah. Well, and this is kind of like, the Brent Johnson, just we got a lot of dirty tricks that we still have yet to pull out of the bag here. Yeah.
Oh, yeah. Yeah. No, the dollar's not dead and America's not going away. I mean, there are a lot of smart people in DC. I mean, and they will come up with all kinds of new things. In fact, in Luke Groman's newsletter this weekend, I'm not going to spoil it because you got to subscribe to get it. He had another one that they're talking about doing that was really brilliant. I mean, and it relates to the euro dollar. So, yeah, they'll figure out ways to do it. But at the end of the day, Adam, as you and I both know, all of those things lead to some form of currency debasement because G growth has to exceed R rates, and the only way you can do that is to inflate G. And inflate. I mean, and we're not getting natural growth because it's not like we're having a huge productivity thing. We can get into AI if you want. But the form of growth we're going to get is inflationary growth, right?
So let me ask you this, because you're, I think, not uniquely positioned, but few people have they straddle the world that you do of sound money, Bitcoin, and what's going on here in the areas we're talking about. These stable coins, the administration's hunger to get the stable coins involved. I mean, to me, that seems pretty transparently, they just want additional buyers of treasuries.
You got it.
It's just incremental demand, hopefully trying to bring some of those longer yields down.
This is a great place to go into because I got a lot of thoughts about this. Okay, so yes, I mean, again, they're starved for treasuries. They've got 7 to 9 trillion. They got to roll over. They don't have enough buyers. They're going to find ways to do it. And what they went and they noticed, these stablecoin guys, of course, Circle and Tether, all they do is buy stablecoins. Well, not true. They buy some gold too, but
I mean, all they do is buy treasuries. The stablecoins,
treasuries, buy treasuries. And so, Tether's 160 billion and Circle's 60. So there's 220 billion dollars of stablecoin, round numbers, demand for treasuries. I mean, some of that, as I say, goes into gold, but they've got to roll over 7 to 9 trillion. Now that number has been growing at 50% a year, but most of that is actually, I was at a show, Adam, and I learned, those stable coins, what those are really being used for, that's an alternative to the SWIFT system. Stablecoin market grew when we shut Russia out of SWIFT. And suddenly I was at a dinner with a bunch of Russian business people, and they all said, yeah, we all just got Kraken accounts and started using stablecoins because we couldn't use the SWIFT system to make dollar payments, right? Mm-hmm. So that's what's going on there. And their whole notion that stable coins are going to bail us out, that kind of reminds me of Doge. And we all kind of know how Doge worked out, right? Mm-hmm. We're going to save 2 trillion. No, we're going to save 1 trillion. Well, maybe we'll save 300 billion. I mean, right now, it's kind of like unclear that we're really saving anything. I mean, I think they got some bad programs, but it's certainly not what Elon and Vivek were originally discussing, right? And I think the same is true with the stablecoin market. Although, again, kind of as a teaser, what Luke had in his most recent letter talks about something that would arguably drive a lot more demand for stable coins, and then that would be the balance sheet needed in order to buy more treasuries. But yes, they need to find somebody to buy those treasuries, but I'm pretty sure they will. I mean, because they've got the pen, they can write the laws, they can change everything. They've got offshore accounts in the Cayman Islands. I mean, we're not going to fail tomorrow, and the dollar's not going to go away tomorrow, and the U.S. isn't going to fail. But guess what? We're going to have inflation. I'm really confident about that. I mean, we might have really short-term deflation. I mean, I think.
Well, and that's where I'm going. Like, will the yield problem potentially solve itself in the near term if the economy slows enough?
Yeah, it could. I mean, I could easily see. Let's say something really breaks, like the AI bubble bursts and a few bad things happen, and the tariffs really bite, and unemployment really starts to go up. And, we kind of hit a deflationary trend. I could see the 10-year, declining from the 4s into the 3s. I mean, and everybody's kind of, I mean, stock market's down, 10, 20, 30%. I mean, it's possible. Although if you look at, on the tariff, I mean, it was interesting. On Liberation Day, the stock market got whacked pretty hard. Bond market got whacked too. I was kind of like, huh? That's not so good.
Yeah.
Stock market going down, the bond market should catch a bid, and it didn't. So, yeah, what you're talking about, that's the old history playbook, and that's probably how it should work. If there's a big enough deflation, bonds should catch a bid. But, on the other hand, that debasement horse is out of the barn. Gold is running free, silver's running free, Bitcoin's running free. Geez, you gonna let a little stock market burst, stop people from going into sound money? I don't know. I mean, it's a question mark, right?
Well, you're taking it where I want to go, and just to let you know, there folks I've been interviewing recently. Jim Carson comes to mind from Kai Volatility,
I didn't see
who
that.
pretty much has that same outlook. Like, okay, it's going to get tougher. Um, the economy is going to slow down. You'll have probably some safety trade coming into bonds and stuff like that. But like you, he expects the same policy response. So for him, he's like, this is a trade for bonds. Like
Yeah,
this is
exactly.
something that you got to play, but you got to, again,
Exactly.
be active
Well,
in
and
terms
I
of how to play.
remind everybody, I'm a multi-year guy. I mean, I'm not playing quarter by quarter for my results. I'm trying to manage in a 2, 5, 10-year time frame, and then I'm going to retire. So,
Yeah. Yeah. And I mean, to that point, um, they in the old days, they used to say that Volcker and the heads of the Fed looked at the gold, watched the gold price closely because it was basically the mirror being held up to
yes.
show the dollar
Oh yeah,
devaluation. Right now,
absolutely.
I think that maybe they began to care a little bit less about it in the past decade or so, as Grant Williams famously wrote, back in 2011 or 2012. Like nobody cares about gold. Like, yes, I understand all your reasons for why this should happen, but right now nobody cares about
Oh,
it.
that was the truth. Yeah.
Yeah, now they're starting to.
Mhm.
But I think maybe in this now we're getting into the price action that we're seeing in we've seen in Bitcoin, and then we're now seeing in gold, and then as recently silver. It does seem like enough people care that maybe there is a sustainable repricing going on in these things where people are saying, look, you know what, we kind of relegated gold, silver, precious metals as the barbaric relic. We initially were looking at Bitcoin as just make believe, money, but now we're really beginning to wake up to this sustained, hey, no
Yeah.
matter
I mean,
what
I
choice
think.
gets made, it's going to reduce the
Yeah, I
purchasing
mean,
power of the
I think the
dollar.
last 4 years have been very instructive. I mean, if you held 20 or 30-year bonds, you've lost 30, 40, 50% of your purchasing power. And if you held gold, you're up 200% in bond terms. If you held Bitcoin, you're up 2,000% in bond terms. That's from the last 5 years, from 2020 to present. So that kind of a move, I mean, what you described with Lacy and the deflation, I mean, could there be a severe counter trend move? Absolutely. Absolutely. And I think people have to be aware of that and prepared for that. And frankly, it's probably due to come because we're all feeling pretty giddy right now that we've been right. And so it could come at any time. But again, I just know where I think we'll go. And I see some things on the horizon that I think are very positive. We haven't talked at all about the Fed. And I don't want to get into all the Real Housewives of the Fed drama that's been going
Yeah.
on. But we do know that Powell terms out in May of next year. And the Trump administration is aggressively campaigning for lower rates. And so I don't think we've broken the last inflation cycle. And I think we can almost be assured that starting in May of next year, we will have a very dovish Fed. And so I think that the sound money alternatives to the dollar, they can all smell that. And that's why they're doing what they're doing, right?
So do you think that's driving the recent action here? Is that people are thinking, oh, it's because
I
we're
think
going to
it's
have a
part of
dovish
it.
Fed that follows the
I
president?
think it's part of it. I mean, I think it's a combination of things. I think it's the Doge failed. I think it's the Liberty Caucus caved. I mean, what happened to the Liberty Caucus? I mean, Trump bullied all of them except for Massey and Rand Paul into basically accepting a huge increase in spending bill, right? The big beautiful bill came
Yeah.
through. I mean, it's right. I mean, it's just, and then even Besant pivoted when he said, "Hey, everyone was asking about." He said, "Well, we've kind of changed our focus. Our focus now is on growth." I mean,
Yeah. Remember,
it kind
he
of
was talking about detox. We're going to have this period of detox. And it was like,
exactly,
oh,
and then
maybe not.
maybe not. Maybe that's not such a good idea.
Yeah.
Let's focus on growth, and it's almost and it's industrial policy like, and they've they've shown you that they're going to take the gloves off and do whatever it takes. Hey, Intel, guess what? We get to own a piece of you. You know, I mean, and I mean, to me, they're going to, you know, I think the military has told them that this is existential shit, and that the bond market. I mean, I'll tell you another interesting thing. So I'm at the Bitcoin show in Las Vegas last year or early this year, and a guy who's very highly placed, and I checked him out. I did all the LinkedIn on him in the defense establishment. I mean, 3-letter agencies, one of which was the NSA, came up to me and said, "Your book is burning up the halls of all these agencies." And I said,
Really?
Yeah. I said, "What the hell are you talking about?" And he said, "Well, our job is to look at existential threats to the United States, and hyperinflation is one of them. And I've told everybody they got to read your book to understand the issue." Right. And so, yeah, isn't that interesting? Right. So,
I mean, I'm not surprised that a great book is getting widely read, but it's similar to my question to Lacy, where he was talking about Kindleberger, and we were talking about how the Fed had kind of been saying right up until Jackson Hole, "Hey, everything's fine, everybody," and then all of a sudden, Powell was like, "Whoa, wait a minute, we're starting to see the economy cool more than I wanted to," right?
yeah.
And so they're beginning to maybe, say, "Hey, we don't want to risk."
Maybe we're behind the curve. And no, I mean,
Right, but the point is, just let me finish the point, which is, like Kindleberger's a famous economist. He's written books on,
yeah,
like,
right.
the Fed has how many PhDs? Like,
Yeah.
so what surprises me about your story is just like the clear lack of financial literacy that we have on average across government, because a lot of what you're talking about, you would think anybody that was sort of remotely connected to fiscal or monetary policy would have a general sense about,
I
but
agree.
apparently not.
Well, I think it is kind of stunning. And as he talked about, they're all neo-Keynesians, and there's nobody who's, a neoclassicist like he is. I mean, yeah, no, it's look, I mean, there's a part of our government that's actually kind of smart. I mean, borderline parts of it are evil as well. But I mean, at least, I know that Jason Lowery wrote something called Software, which is the strategic case for Bitcoin. And he told my partner, David Foley, that, look, the people that run the Pentagon, run the Defense Department, run the DOD, et cetera, they understand what the sound money, what Triffin's dilemma has done to this country. They understand the sound money thing. And I was trying to make that point earlier. I mean, it's an existential threat because, as we've now read, Adam, basically, we couldn't even go to war with China if we want to, because they've got all the rare earths we need to build our weapons. I mean,
Right.
it's just like, whoa, how did that happen? Well, somebody wasn't paying attention, and that's and so Trump comes in with a very blunt instrument of tariffs, and he's swinging this axe around. But good God, somebody had to do it, because the route we were on was literally towards becoming, just a vassal state of China. And that's not a good outcome.
All right. So I got a bunch of questions here. I'm going to
Okay,
start
where do
putting
you
them
want to go?
through. Well, and you're touching on one of them here, which is, um, you know, it's not a political channel. You're not
Um,
necessarily. I don't see
I'm
you
a
as a
libertarian. I'm very
yeah.
much a libertarian.
You're a libertarian. You're a guy that kind of calls balls and strikes as he
Yep.
sees them. What kind of grade do you give the Trump administration's economic policies so far?
I'd probably give them a B minus.
Okay.
I mean, I think they're certainly better than the alternative. I think they understand that sound money is important. I know Robert Kennedy understands it. Everyone should go listen to the Robert Kennedy speech at Bitcoin Nashville. It's an outstanding speech. He gets it.
When was that? When was that
It
made?
was not this year. It was probably 2024.
Okay.
Highly recommended. Besant gets it. I mean, Besant's an admitted gold bug.
Yeah.
Besant's positive on Bitcoin. Miran is positive on Bitcoin. I mean, I think they understand what unsound money has done to this country. I think they understand how Triffin's dilemma has hollowed out the manufacturing base. I mean, Besant said it, or I mean, JD Vance said it. Wall Street's been doing just fine. It's time for Main Street to win. And by the way, for that to occur, the bond market's got to die, and it's gonna die. I mean, they're gonna kill it, and they don't say they want a cheaper dollar, but they want a cheaper dollar. They want a serious dollar devaluation, because that's necessary, in order to solve this imbalance that we've got, that has put us in the position that we're in. So I mean, I think they mean well. I think they're going in the right direction. I think they're trying hard. I think some of it has been ham-fisted. I think some of it is unrealistic. Obviously, Liberation Day was kind of, I mean, what happened on Liberation Day was fascinating to me, right? Because the bond market basically schooled Trump, right? We're going to do all these tariffs, and the bond market and the stock market, the bond market falls, stock market falls. And well, maybe we're not. Maybe we're going to rethink that. and so, I mean, so they, okay, but fine. So they adjusted. Okay, we'll put a 60. Was it a 60-day or a 90-day extension? I think it was 90, but they put an extension on when they went into effect, right? And
I'm trying to think if they did more than
I
just
can't
one
remember what it was.
extension.
Somebody put it in the show notes. But anyway, the bottom is they put an extension in, and the market recovered, so on and so forth. So I think their intent is right. They're kind of feeling their way around in the dark. I give them, who could get it perfectly right? I mean, it's 20 years of misadventure in the wrong direction. I mean, you can't fix it in a year. I mean, he hasn't even been there a year yet, right?
Right. And I would say from a monetary policy standpoint, you would say it's more like 50 years only because
well, that's right. If you want to go back to 71.
Yeah.
Yeah, right. Right. Yeah.
Yeah. Well, look, I think this is coming from your book, but just to help listeners here. So, Larry, where does this end up currency wise? Do you think the U.S. returns to a backed currency of some sort at some point in time? I'm sure to get from here to there is going to be wicked painful in a lot of ways. But do you think we end up with a new monetary regime that's backed?
Your Marblehead upbringing is showing, because there aren't many people I speak to who use the word wicked.
When you were talking about Lacy earlier, I was going to say he's wicked smart.
He's wicked smart. Yeah, exactly. Yeah. Yeah, that's a great question. And yes, I do. And I think only because it's the Churchillian line of Americans do the right thing after we try everything else. I mean, I think the way this goes is that inflation becomes the problem of our age for the next 10 years. And at some point, enough politicians like Kennedy or Vance or others recognize that this is the core of the problem and that we need to return to some form of sound money. And actually, chapter 26 in my book is the speech I would give as a president to how we do that and the reset we would need to do. And it's been done before. I mean, on a different scale, smaller, but with some different facts. Roosevelt did it in the 30s, in 33, grabbed all the gold and repriced gold to fight deflation. So, that could be done here. And there are many people who've described it. Judy Shelton has proposed, a gold-backed treasury bond. That would be one way to do it. You could also do a bit bond, which would be a treasury with some Bitcoin attached to it. I mean, but yes, we must, and we will. And just natural forces will cause us to drift back to sound money, which is not to say the dollar will necessarily disappear, but the dollar is going to have a lot of competitors. And certainly the bond market, I look at gold and Bitcoin as really reserve assets, not necessarily reserve currencies. And currency, as you know, has two pieces to it. It's a savings vehicle, it's a store of value vehicle, it's also a medium of exchange vehicle. Well, in today's world with technology, you can exchange one thing to another in a heartbeat. You got Venmo, PayPal, dollars, yen. I mean, it doesn't matter. The currencies will all be out there, for payments. But what people will be willing to hold that they trust will be gold, silver, and Bitcoin, in my view. Okay. And those will come center stage, and perhaps even to the point where I kind of dream and think in my book, and we're talking probably after I'm gone, we're talking 20 plus years out here. I actually believe my kids might be doing transactions of Satoshis, which is the smallest unit of one Bitcoin. So, and the dollar might be a thing of the past, and everyone might be saying, well, how could it be that you guys let 12 people in a market-based economy set something as important as the price of money? I mean, we all know price fixing doesn't work, that, the interest rate ought to balance the supply of savings against the demand for capital. That's what the interest rate should be. It should be set in the free market, full stop. But of course, what we have is a bank and government cartel that sets it. And that's why we have all these problems. I mean, look at it, Adam. You have 0% interest rates, which makes everybody who can borrow wealthy, or you have 20% interest rates that almost banked my dad in 1980 when we were eating tuna fish sandwiches for dinner for weeks on end. I mean, it's just, it's kind of it's just an up and down system that's very painful because it's run by a cartel that is, the banks and the governments. So.
All right. I am biting my tongue to not go deeper on some of these things. Just
I'm happy to go if you want. I've got the time if you want to go deeper. So just let me know.
I appreciate that. I just don't want to keep you here for hours, but let's keep hacking away here. So, as you referenced earlier, silver is above long-term resistance. Really, I think getting above 35 was a big deal.
I agree. Yeah, that was the first measure. 40 is a bigger one. Yeah.
Yeah. And now at least on the day we're talking, silver futures are 41
Are
something
they?
right
I
now.
hadn't looked.
Yeah.
Yeah.
Yeah, the momentum we saw that started on Friday is continuing. Now, of course, US markets aren't open. We'll see if that holds
Yeah.
tomorrow. But we've got that, and we've got gold futures at an all-time high here.
Right.
So what significance do you place on this new rarefied territory that the precious metals find themselves in?
Well, it's a breakout. It's a breakout after many years of suppression. And, if you kind of, some people would say, well, these are too expensive. They have to come back down. And I would say, no, no, no. You need to compare them to the outstanding money that we've created. And, I mean, Brent Johnson has a great table. It's actually in my book as well that shows that to fully back the dollar with gold, and this was a couple of years ago, at today's, and 100% backing, by the way, is not required to have a gold standard. I mean, you can run a gold standard at 20 to 40% backing.
Right.
Right? But if you wanted to 100% back the dollar, M2, with gold, you'd have to have $90,000 an ounce gold. Now, it's not there. It's at 3,500, and so I believe they have a lot of room to run. And people have asked me my outlook. I mean, I think we see 4,000 this year and probably 5 the next year, and I can clearly see up to 10, in the next 5 to plus years. And with Bitcoin, I can kind of see, I think 140 this year and higher following years. I mean, they'll probably be at some point, it'll get ahead of itself and we'll have a real, we'll have that 50% pullback that'll scare people. But in, 20, 30 plus, I think Bitcoin's $1 million a coin. I said that at New Orleans, I think it was last year, and a lot of people guffawed and made fun of me and argued with me and this, that, and the other. But once you really kind of dig into what it is, which is to say, it's the first commodity that can't be manufactured beyond its limit. So so we've never really seen anything like Bitcoin before. I think people have to get their head around that. There has never been something like this. There's never been a financial thing with a fixed supply, ever. Gold grows at 170 a year. In 40 years, we'll have twice as much gold on this planet. In 40 years, there'll still only be 21 million Bitcoin, right? So wrapping your head around that is why it can just keep going for a very long time, and I think it will.
So a couple of things. First off, thank you. You, as a good interviewee, you interpreted or anticipated the questions I was going to ask you. So thank you for those price targets. The 1 million prediction for Bitcoin, just want to let you know, a few others share that. Mark Moss made that prediction about a year ago when he spoke at our conference. But I mean, I know when you made this prediction, Larry, yours was no less courageous to make it at that point in time. There's still a lot of people that I think can't wrap their brains around that. Let me ask you this. I asked you this a little bit last time, and we should probably spend a whole interview on this at some point in the future. So let's just give it a tiny bit of discussion here. But you said, something like Bitcoin hasn't existed before, where it's intended to not be able to be, it's fixed. It's intended to be fixed at what it is, right? I think so. There's a lot of people, I think, who watch this channel who don't own Bitcoin, and they're not philosophically opposed to it. They're probably a lot like me, where they should be really philosophically for it because we're fans of sound money and stuff like that. But one of the hurdles they have is, all right, I get it, Larry, they're not going to make any more Bitcoins than the 21 million that are out there. But why can't somebody tomorrow create another coin that's just as competitive, maybe as a few other bells and whistles, and that's going to be fixed too? So how does Bitcoin get to keep it? How does it defend its value?
It's a great question. It's a great concern. We deal with it a lot, and I fully understand it. And all I would say is that it has to do with the network effect of what people adopt as money. And so, and don't get me wrong, I accept that as a risk. It is one of the risks. Okay, it's not like a zero probability risk. Okay, but a good analog to that might be, well, okay, how about tomorrow somebody's going to make a better Amazon, right? They're going to have all the things for sale, all the people buying there, all the usage of it, et cetera. It's going to emerge. It's going to have some feature that causes it to make Amazon die, and it's going to win. I mean, in other words, there's a, it's called Metcalfe's law. There's a network effect here that's in place where, it would take something substantially better to cause people to migrate off of this network and onto a better network. Do you follow me? And people say,
I totally do. So there's two things here. There's the network effect, which is the bigger the network, the more value it has, right? That's why
Correct.
eBay beat every other auction site out there because they just had
Correct.
the most sellers, and then so
Right.
that attracted the most buyers, which then
Right.
attracted more sellers, right? And it
Well,
snowballed.
and Google and Amazon are other examples, right? Yeah.
There are other examples of that, but Google is a great one to mention here. So then there's switching costs, right? Which is
Right.
like, look, I'm using Amazon or whatever, I'm using provider X, and just for me to stop using it and move over to this guy is going to have a big hassle factor, right? And so
Right.
that's true. That goes hand in hand with a network effect. But let's look at Google, and this might not be a direct analogy, but AI is coming out,
I
and
know.
Google
No,
is
it's,
panicking
it's a
because all of
risk
a
to Google.
sudden, yeah, all of a sudden, a ton of people are doing their searches on
Oh, I
ChatGPT,
know.
and
No, and
right?
my 30-year-old daughter works at Google. I mean, and so we've had this discussion,
Yeah,
and again, Adam, I don't think it's impossible that there could be something that would be better that would come along. I think, you'd have to see it, and you'd have to, that you could see what would happen is if it was doing extremely well and Bitcoin wasn't doing well and people were migrating from Bitcoin to it because of its better qualities, well, then that would be a data point, and maybe you go over there. But I think, one of the other things I think prevents it from being, that happening is it's based on this proof of work, which in the early days was very hackable. If you get a 50% attack, 51% attack, if you control more than half of the mining capability of it, you could, basically corrupt it and cheat it. Okay.
hmm
And when it was smaller, that would have been possible. I mean, I know people who were mining them on, Mac 2s. I mean, it was crazy how easy it all was. But now you've got billions and billions of dollars, 20 plus billion dollars probably spent in the mining industry, on these specialized ASIC factories that mine it. And, the notion of somebody conducting a 51% attack, or just, it's ridiculous. You couldn't, it couldn't happen again. And and if you look at it, there are people who debate, is this a discovery or is it an invention? I don't, it doesn't really matter. It's the same with an airplane. Was that a discovery, an invention? I call it an invention. When they invented digital scarcity, you only get to do it once. And that's really the big breakthrough here. What Bitcoin brought that was never existent before was a form of digital scarcity. And so, can somebody else create digital scarcity? Yes. But the first mover advantage and the largest network, I think, win, unless for some reason, if Bitcoin Core really screws up Bitcoin and somebody comes up with a much better version of it that causes a lot of people to go over there instead of here. And those things are possible. I mean, I don't discount those. And I'm always looking around for other things to wonder, could that happen? You know what I mean? But to
yeah,
date, I don't see anything like that. You know what I'm saying?
okay. And
Yeah.
I appreciate your open mind on this. And just again, my one man's
Oh, I
opinion
mean,
is
it's a legit. I got to tell you,
yeah,
I had all these concerns myself. I mean, it's this you're moving down the rabbit hole of believing in Bitcoin and owning some Bitcoin. It's hard. I mean, I had Max Kaiser telling me in 2011 or 12, you got to buy this, dude. And I was like, it's like, Max, what the fuck are you talking about? I mean,
right.
sorry, pardon my English. My wife's gonna be mad at me, uh, because she monitors my stuff. What are you talking about? I mean, they've tried this. I mean, there was Hashcash, there was eCash, there was digital. I mean, it doesn't work. It just does not work because every one of those had a technical flaw. And of course, we've got the halving, and the difficulty. I mean, all the things that went into constructing Bitcoin,
Right.
SPA-256, the cryptography. I mean, it's kind of an amazing collaboration of a bunch of technologies. It's like, oh, wow, we cracked the code. We figured out digital scarcity. Do you know what I mean? And it all came together.
Yeah, and look, I don't, just my opinion, but I agree with Larry. Like I don't see the high capability of somebody wresting Bitcoin from, the crown from Bitcoin anytime soon. Maybe never. I'm totally
Right.
open to the fact that, hey, it might be the long-term winner here. So
Mhm.
even though I'm raising these questions, Larry, it's not like I think it's going to go
Oh,
away
I know where you're at. I feel like you're almost orange pilled. And I mean, once you get settled in Nevada, you got to start buying some because then you'll be in a tax-free state. So
Yeah, exactly. And look, part of it too is I'm sure once you buy it and you experience some real growth in it, then you get that,
it's self-reinforcing. Yeah, I mean, the
yeah.
stuff I bought at 300 or 400, I'm feeling really great about, right?
Yeah, I mean, you must be feeling awesome about that. So, last question on this, just again, poking holes so that the
Sure.
skeptics of Bitcoin can hear your answers to them. Back to AI, I think AI has surprised many people, not even doubters, maybe even some of its fans, with in certain areas about how quickly it is improved, right? And it
Yeah, that's
and
for
it
sure.
does improve at an exponential rate, right? So there is the risk that maybe not tomorrow, but maybe not too far after tomorrow, we really get into kind of quantum computing and cryptography that can break Bitcoin security.
256. Yeah, no, that's the other thing I worry about, and that's a legitimate risk as well. And you know, I'm not a computer scientist. I don't write code. I don't understand any of the issues there. I just listen to the smart people, including Adam Back and Lynn Alden and others. And I just from what I understand, you know, where they are on AI or where they are on quantum and the pace of the development, it's not even remotely a threat for at least a decade and maybe two. But as you point out, we have been. It's funny, AI in some ways is really positively surprised, but I would also say in other ways, you know, I think there's a lot, AI reminds me a lot of the internet bubble. There's just a lot of hype. I mean, does it make my life easier and your life easier? Sure. I mean, I can ask a question, get an answer like that. It's fabulous.
Right. But you go to a website and you use their AI chatbot to get help and you're pulling your hair out. Yeah.
Yeah. I mean, and I mean, is it going to, you know, I mean, I've heard stuff like, well, in 5 years, there'll be no white collar jobs because of AI. And I'm like, I don't think so. You know, I mean, there might be a few less paralegals because one paralegal can do 3x the work. But, you know, and there might be a few less financial analysts. You know, I mean, there's some great uses of it. It's a tool that helps people, no doubt. And I, you know, I think in 10, 15 years, it'll probably have a larger impact than any of us could imagine. But I mean, the market is now pricing it as though it's all going to happen next year. And, you know, I think, I mean, wasn't there, I read a recent survey that said like 95% of the companies have been involved in it, you know, said that the projects have kind of been a failure. And yet, so many of these technical big tech firms have been putting billions and billions of dollars into it. I mean,
into it, yeah,
paying huge bonuses to hire people. I mean, it's nuts. It feels very 2000 like to me in terms of, you know, we're never going to have enough bandwidth. You know,
I mean, having seen that show as well, it does to me as well, especially just some of the gargantuan valuations some of these firms are getting. And that being said, a lot of cases they do have real revenues, but again, these are revenues by people who are it's with capex, right? So it's on the hope that they're going to make some operating profit down the road.
Right.
That to your point, the operating profit.
I think I mean, I paid $200 to ChatGPT because I want the unlimited version of it. I think they're making pretty good money off of that. But it's, you know, I mean, like I look at the Palantir valuation. I mean, and of course it's all government spending anyway. But I'm just like, huh? You know?
Yeah, but 200 times sales or something crazy like that.
I just that just can't last. But I mean, you know, the problem with these bubbles is they go on longer than you think, and you either look stupid in the beginning or stupid afterwards. So
yeah, that's the classic Hussman quote. And yeah, and with this one too, you know, just as Scott McNealy famously
I love that.
said, hey, you guys are valuing some microsystems at 10 times sales, you're nuts. Sam Altman just came, I mean, of all people, Sam Altman just came out and said, this is a bubble.
Yeah, right.
Yeah.
Right. Yeah. I mean, I don't know. Timing the bursting of bubbles is extremely tough. I mean, I know people who tried to short Japan. I know people shorting the internet. And I mean, look at, you know, one of the greatest investors of our times, Druckenmiller, you know, got on the wrong side of the internet bubble with, I think he bet billions of dollars and lost hundreds of millions of dollars on the internet bubble, you know, by shorting it.
But exactly.
98 or 9. Yeah.
Yeah. All right. Curious to hear your answer to this question. I think I know what it is, but so obviously you are a substantial investor in both the precious metals and in Bitcoin.
Yeah.
Do you trade between the two at all, depending upon their relative valuations, or are you just stacking and hodling as you go?
I'm stacking and hodling as I go. So what's happened to me, Adam, is that I feel much more bullish on Bitcoin than I do on gold and silver, and which is not to in any way denigrate gold. So I love them. Hate it when people knock them. But at the margin, I'm a buyer of Bitcoin, whereas at the margin, I haven't bought a lot of new gold and silver. I bought a lot of gold and silver miners, which is a slightly different kettle of fish with a lot of risk involved. And of course, what's happened to me over the years is my Bitcoin weighting has just become higher because it's gone up faster. And I've never, you know, I'm not into selling my gold and silver. I'm not going to do that. But you know, I mean, let's say I earn a salary at my job, which I do, and let's say I have some excess capital and I want to put it somewhere. I usually look for the best opportunity. I mean, recently, actually, that's been in some gold and silver stocks, but in general, if it weren't there, you know, I would be a buyer of Bitcoin.
Okay. And is that pretty much for the reason that all things being equal, you know, given your outlooks, you think Bitcoin has a higher probability of increasing by 10x than gold does?
I think that's right. I mean, in the book, there's some good charts that show how Bitcoin has outperformed gold. And really the reason for that, I mean, gold is the best form of money that's ever existed until Bitcoin came along. And, you know, it protects against purchasing power, but it's also fully distributed. The reason Bitcoin's outperforming gold is that you've got an adoption curve going on. It's this
Right.
Malcolm Gladwell, we're only in year 15 of something that I think is going to be adopted for a bunch more years. And so, as we know, the total gold market is $20 billion. The total Bitcoin, or I'm sorry, $20 trillion. The total Bitcoin market is $2 trillion. And so, there's just more growth in Bitcoin, right?
All right. You had prepared a slide
Oh, yeah.
comparing gold and Bitcoin. Let's not forget
Oh,
that. So why don't you pull that up?
yeah, okay.
As you're pulling it up, let me just ask you this question. So
Right.
to the person who just hasn't gotten on the Bitcoin train yet, but understands, follows your logic, and is saying, maybe I should own some of this stuff, but man, the big money's already been made, and me buying in is going to have to be an admission to somewhat that my idiot brother-in-law who bought in 7 years ago, who probably bought in for all the wrong reasons, but made a crap ton of money. Would you just say, forget all that? It's just a sunk cost.
Yeah.
Just
So
close your
I
nose
would
and buy.
I'd make a couple of statements to that. I'd say one, zoom out, because you might look wrong short term, but in 5 years you're going to look really right. If you're in, I mean, let's say you're a gold and silver person, you got all your money in gold and silver, you got none in Bitcoin. Okay. What I would submit to you is that's not correct. Zero Bitcoin's the wrong allocation for something that's this asymmetric. And even if you only sold 10% of your gold and silver and put it into Bitcoin, you should do that. And by the way, in the short run, the Bitcoin might go down, but in the long run, I think it will outperform the gold and silver. The other thing I say to people who are experienced, what you're describing is price shock. I've had a lot of people come up to me. As you know, I've been a sound money person for years. I've been pumping gold and silver for years. People think, my wife used to say, "Don't talk about that shit at cocktail parties. We need to stay popular around here." Um, yeah, and now they're
I
calling
think
me.
my wife might have said something similar to me too.
Yeah, and now they're calling me and say, "Hey, what should I do? Is it too late?" And I'm kind of like, well, it would have been better a year or two ago, no doubt. But I try and use the following analogy. I've used this in other podcasts, but I'll just repeat it because I think it's relevant. I think fiat currency is failing slowly but surely, consistently over time. It's sinking, kind of like the Titanic is sinking. Okay. I think gold or sank. I think gold, Bitcoin, and silver are seats on a lifeboat away from sinking fiat currencies. Now, I got my first Bitcoin seat at 300 bucks. I got my first gold seat at 300 bucks. I got silver seats at $5. They're a lot higher right now. Those seats cost a lot more today than they cost back when I was originally buying them. But if what's going on in fiat currency continues, I think you want to own one of those seats, right? Even if it costs you $3,500 an ounce for gold,
Mhm.
or 120,000 a coin for Bitcoin. And of course, as you know, you can buy fractions of both. You don't need to buy a whole Bitcoin. You don't need to buy a whole ounce of gold. So I just think to not have some allocation in this bucket is not, it's not good asymmetric investing, I guess is what I would say, based on what we
Okay.
know about the risks of monetary debasement. And then I think everybody should decide that allocation should be, what are you comfortable with? Knowing that these things are volatile and could go against you 30 to 50%, but you hold them as long-term insurance against the government trashing the money. And it seems highly likely the government will trash the money, right? So that's
Got it.
that's kind of how I speak to them. But I don't know. Can you see the chart that we were talking about that I've now brought up?
I can see it. Let me just make one perhaps poor analogy, and then I'll give you the floor here.
Yeah.
So when it comes to buying into Bitcoin because of you thinking it as sound money and perhaps the future superior form of sound money, it's like the fall of Saigon back
Yeah.
in the Vietnam War, which is like, don't haggle what the price of your seat on that last helicopter is going to be. Just get on it.
Exactly. That's I think it's a very good analogy. You want that seat on the helicopter badly if what's going on in fiat continues. And as I say, I'm not suggesting to anyone that you should put 100% of your money in this bet. I'm just suggesting to a lot of people who have zero in the bet that, like, oh, no, 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 wake up and pay attention to this. And I think if you do, I think in 5 years or 10 years, you'll thank me. And in the same way that people today are like, well, gosh, it's 100 grand, Larry, you paid 10 for it. How can I pay 10x what you paid for it? And I'm like, okay, but just accept that in 6 years, say, and I think it'll be about 6 years to go to a million. In six, because it's 10x. It's order of magnitude grown like a bunch of times. It went from 1 to 10 to 100 to 1,000 to 10,000 to 100,000. In 15 years. So kind of every 3 to 4 years it would 10x, and I think that it'll 10x again. And so at some point in the future it'll be $1,000,000, and you'll be thinking, God, I wish I'd bought it at 100,000.
Right.
Oh, that seemed cheap. And it's all just, don't let the price framing mess you up of what it is. Do you know what I mean?
I do. And sorry, last question before you talk about the
Yeah.
chart here. Do you have guidance, any strong guidance to people when they say, okay, well, what should I buy in at? Should I actually buy it and buy the coin itself and hold on an
Yeah.
exchange or have it in a cold wallet? Can I use one of these ETFs? Like, what do you have a
Yeah,
strong feeling?
I'll give you the real quick overview on that because that's a long, deep rabbit hole that we could go down. I mean, to get price exposure to it for the average person, because learning how to self-custody it and manage your own keys is a time-consuming process, and for those who aren't technically literate, it's scary. You can get price exposure to it with your, with your brokerage account by buying IBIT, which is the BlackRock one, or FBTC, which is the Fidelity ETF, and you've got price exposure. And you're paying 30 bips as a fee, which isn't very much. And so if it doubles, you're going to double your money. Or 10x, you're going to 10x your money. But the issue there, just full disclosure, is that if we ever had a Democratic administration in the future and Stephanie Kelton was the Treasury Secretary and they decided that Keynesianism was the rule of the land and that Bitcoin and gold were ruining their beautiful fiat system, and that therefore they needed to confiscate all the Bitcoin, very much the way Roosevelt did with 6102. And they called up Fidelity and they called up BlackRock and they said, send all those Bitcoin to us and we're going to give you dollars. Well, you'd be screwed because the value of Bitcoin would skyrocket in dollar terms and you would have lost yours.
Mm-hmm.
And so that's the argument for self-custody, which is that's an involved process that probably we don't want to go into in this call or in this pod, but people can easily look into self-custody Bitcoin, and a lot of people can help you with that.
All right. That's a very helpful, concise answer. Thank you. So let's go to this chart.
Okay. So this was prepared by my partner, David Foley, who runs the Bitcoin Opportunity Fund. They're a private partnership doing extremely well. A lot of Bitcoin public and private companies. Great results. They're open to accredited investors. I've got to put in a little advertisement there. I'm an advisor to them, not a principal. The Foley and Lavish run it. But he prepared this chart. And what this shows, the orange line is the price of Bitcoin, and the gold line is the price of gold. And of course, the scales are very different, right? I mean, because Bitcoin's gone up a lot more than gold. The right-hand scale is the price of gold. The left-hand scale is the price of Bitcoin. I think it's log because of how fast Bitcoin has gone up. But when you lay the two over each other, what you see is that gold tends to look at early 2019. Gold tends to smell monetary debasement before Bitcoin. So it broke out and started running, and Bitcoin sat flat from 2019 to 2020-ish. And then suddenly it woke up, to what was going on with COVID, and it went berserk. It just went straight up and outperformed gold. And then, of course, when the correction came post that, and they could smell Powell was probably going to get tight, then Bitcoin corrected a lot, and this was the Sam Bankman-Fried dip. But and gold corrected a bit too. And so, but back again, 2022, when they can start to see that the Fed is probably getting closer to the point where they're going to pivot again, which they did by announcing in the fall of 2023 that they weren't that the rate hiking cycle was over. Again, gold started to smell the debasement first. Bitcoin started to go up a bit, but then Bitcoin really caught fire and raced past gold. And then when it corrected more. So, and again, you see it here, then Bitcoin broke out again. Well, then eventually gold broke out again. Bitcoin caught on, took off fast. So we're now in a period where, basically the Fed has been on hold. They've started cutting, not aggressively. I think they're going to be forced to cut aggressively. And gold's been forming a big bull flag that this chart's not updated. It just broke through that 3,500 number. And Bitcoin's actually kind of languishing. And I got a lot of grief on my Bitcoin, or my Twitter thread. What the hell's going on with Bitcoin? Why is gold working and Bitcoin's not? And I'm just like, guys, Bitcoin smells it first, or gold smells it first, and then Bitcoin follows through much harder. And that's just the pattern that we've seen over these years. And so, that's how I get to my belief that we'll end the year at 4,000, 4,500 gold. And then this Bitcoin line is going to, at some point in here, really catch fire. And we're going to 140, probably, late this year, early next year, up from today's what are we at, 108 today, I think. So, but I think it's an interesting chart, interesting way of looking at it, isn't it? And in general, you can see how they're both kind of correlated as forms of sound money. Now, some people say, well, yeah, Bitcoin's a proxy for the NASDAQ. And it certainly was more of that in the past. But I think I've seen some studies that have shown that that's beginning to decrease as time goes on. And that, while it is a liquidity driven risk on asset, it's not trading step for step with what the NASDAQ's doing. And you notice that, in fact, because this year it's greatly outperformed the NASDAQ. I mean, NASDAQ's not up very much this year and Bitcoin's up solidly. So.
All right. Well, really, really interesting. Okay. I've
Stop
got a
that.
few more questions I want to try to
Sure,
squeeze in before we're
sure.
done here. Thank you for going along with me here. I'm going to see if I can pull up this chart, but I wanted to get back to your comments that you had made earlier about electricity costs.
Yeah,
Because
that's in my Twitter feed. Yeah.
yeah, and I'm going to pull that up. So
Oh,
just bear
good.
with me 1 second here. Here's your tweet. I think you were retweeting a tweet from the
Yeah, it's
Kobayashi letter.
Kobayashi letter. Yeah. Isn't that
Yeah, so
something?
yeah, and we can see energy prices take off. And I've shown a chart, Lawrence, of America's energy productive capacity relative to Europe's and China's. And basically,
Yeah,
America and the EU have been moribund for decades. It's kind of like
yes.
a sideways trending line where
I've
China
seen
is
that chart.
just,
Yeah.
yeah, China's just shooting the moon. And to your point, to the extent that AI has now become sort of, an existential race on the sovereign level, like whoever
Mhm.
wins AI is going to be the next, reigning superpower. We have to dramatically increase our electrical production and rebuild our grid. And it seems like the new administration has got religion around that. We got a lot of
Absolutely.
investment going in there, right? But let me ask you this question. So yes, this is uh, inflationary, meaning, electricity or energy is an input into everything, right? So the more
Right.
expensive energy becomes, the more expensive everything becomes. We're
Right.
talking kind of about electricity here, but we could maybe even make it energy writ large. Back when, right before the shale boom happened,
Hmm.
when peak oil was, all the talk,
Hmm.
a guy named Jim Paplava asked, who was
I know him.
a
Yeah.
financial interviewer like me. He was a previous generation. Um, he asked a really interesting question. He said, is oil, specifically the price of oil, now going to become the next Fed funds rate? Because it was the limiter on the system, right?
Mm,
The central banks can't print more oil. And if we were
right.
starting to sort of run out and it was just going to get more and more expensive, you could have made the argument that, hey, yeah, oil was going to actually be what mattered. The price of oil was going to matter most to what the economy was going to do, perhaps even more than the Fed funds rate. And I'm curious, given that we have such a deficit of where we need to be going forward, could we be entering an era where electricity costs or just energy costs in general might actually become more important than the Fed funds rate?
Yeah, I agree. I mean, I think, and it's interesting that, but in a way, gold and Bitcoin are energy-backed currencies. I mean, it takes energy to mine gold, and it takes energy to run the
Mine
Bitcoin
Bitcoin, yeah.
network, and doesn't take much energy to run the Fed printers. Well, I guess it takes more than we thought. The new headquarters is going to be 2.5 billion, but right. But yes, I think what you're describing is completely correct and accurate. And I think the reason, it's so sad that this has occurred, Adam, and I laid it out in my book. I mean, you know, China was building nuclear reactors, and they got a lot of coal, and that's dirty, and they're a big polluter, and that's not great. But they invested very, very heavily in nuclear. Meanwhile, we didn't do that, probably because of the oil and gas lobby prevented us from doing that, and we went and spent $8 trillion trying to conquer the Middle East, and then retreated from it, which was just such a colossal, strategic error on our part. I mean, it drives me nuts. I live in Massachusetts. My energy costs in Massachusetts kilowatt hour 34 cents. All my neighbors have Teslas because they're virtue signaling. But I've done the math. It's more expensive to drive electric at 34 cents than it is to buy the gasoline at today's
Hmm.
prices. And it's kind of like, huh? And it's tragic because, as you know, you're from Marblehead. I mean, Quebec has got oodles of, 5 to 7 cent, hydropower, but all the environmentalists in northern New England won't let us run it through their state. Do you know what I mean? And so, yeah, I mean, the U.S. energy policy, I mean, to me, and this is an area where, although Trump is, drill, baby, drill, and open up mines and get all those strategic minerals, and takes an investment in MP and a lot of smart stuff. Boy, I really wish they would take on. I mean, we need a Marshall Plan for nuclear energy for the United States. And it's interesting, in a conversation I had with Michael Saylor, he said, "Don't worry about it, Larry. The reason it's going to happen is that AI is going to demand it. I mean, if you want these AI productivity gains, you can't do this without having nuclear power.
Hmm.
You've got to have nuclear power. And so,
Right. And I believe, I actually don't want to make this assumption, but there's a lot of people that say, and on the way there, we're going to rely a lot more heavily on natural gas as kind of the bridge fuel, and you'll see
exactly.
a lot of new investments in there. Sounds like you see that
Yeah,
happening
totally
too.
agree with that. Totally agree with that. And we've got a lot of natural gas, and that's a beautiful thing.
Yeah, and a lot of cheap natural gas, which is great.
Yeah.
Right? Yeah.
Yeah. Yeah. So yeah, that's all on the come. I mean, um, for those who think I haven't been kind enough to Trump, I would just make the statement that, this administration has been such a breath of fresh air compared to what we would have gotten with the other side. you know, but that doesn't mean they're perfect.
Yeah, and it is interesting, kind of back to my question to you about, can energy set the tune? Will energy set the tune from here? I mean, it sort of is already, right? I mean, you've mentioned, so we've looked at how our chief competitor, China, is just way ahead of us on this, right? And we say,
Yeah.
look, if we want to, the IRA race is going to be won on plentiful, cheap, available electricity. They're way
Yeah.
ahead of us. We got to catch up. So we probably will sort of have an Apollo-esque or Marshall Plan put together
We
to make it
need
happen.
to.
And I feel like it's already probably in the process of getting
I think
designed.
I think they're working on it. I hope they
Yeah.
are. They should be.
And you can say, look, we had a lot of missteps, and you can compare this administration to previous ones, but to really see how badly you could be, we just need to look over to like Germany, right?
Yeah. Well,
And
they've
say,
done even worse.
yeah, yeah,
Although we didn't help them by blowing up the Nord pipeline, but yeah, they've done even worse.
yeah, and so I, I guess my point is hey, we're not the worst at this, but um, what is it that Doomberg says? Well, there's that saying like decline is a choice, and sometimes yeah, if we're not first in the race for something we care about, it's because we were making the wrong policies. The good news is, as Doomberg likes to say, it's a lot easier to remove a political constraint than a geological one. And the
Yes.
good news with America is we still have a ton of resources that we could
Oh
be
yeah.
using more aggressively. And if we
Absolutely.
just get the political constraints out of the way, we can actually maybe have the future we want.
Absolutely. Absolutely. There's a really bright future here if we do the right policies. There really is. We can fix this monetary problem. All this. I mean, I've been accused of being a doomer, and I'm not a doomer. I'm just an older guy who's seen a bunch of cycles, and I know how this works. And so, I can see that we are truly in a fourth turning, and monetarily, there's going to be some real turmoil here. And as I think you said, very presciently earlier in the conversation, there's no way we don't get out of this with some pain. There are going to be some winners and losers, sadly, and but we do need to get out of it. I mean, and that's why I argue that the sooner we get out of it, the better. I want my kids and my grandkids to grow up in a world that's more like the one I grew up in, where we have a middle class and things are fairer. I mean, this world right now is really, really upside down. The book talks about that a lot, as you know.
Well, from your lips to the universe's ears, buddy. Fourth turning, wish we had more time to really delve into it, but quickly, where do you see us in the fourth turning here? And less time-wise and more
Yeah.
disruption-wise.
I don't think we haven't hit the climax in the resolution. That's for damn sure. That's when the currency system will have changed. It's easier to do it time-wise. They tend to be 20 to 30 years long. I think this one started in '08. So that means, 2028 to 2038 is the end point if they're 20 to 30 years long. And some were
Right.
shorter. The Civil War was a little shorter, although if you think that the war started in 1850 instead of 1860, and it kind of did because there was a lot of strife, and ended after Reconstruction in 1870, it was probably 20, 30 years. The revolution was all of that and then some. Yeah, I don't know, Adam. I mean, I think we're getting to the heart of the matter, to be honest with you. I mean, it's the fiat money is kind of failing, and 2008, okay, fine, they put it back in the bottle. They made it to 2020, fine, okay, they got it back in the bottle, but of course it was bigger. The span between those two was quite long, right? 12 years. I don't think it's going to take 12 years for the next one. I think it's coming up in the next 3 years, probably. And then, what happens with a currency event is if you study, and I've read so many books about hyperinflations around the world and study them all, they occur when a quorum of the people come to realize that there's no way the government can ever stop printing money.
Mhm.
And at that point in time, they all just it becomes it's Gresham's law, right? The smart thing to do is to just get the hell out of this currency and own something else.
Yeah, it's
And
when
it's crack
confidence
up boom and
breaks.
prices go nuts and the whole 9 yards. And we've seen it. We've seen it in emerging countries. We've seen it in Venezuela. We've seen it in developed countries like Weimar Germany, Zimbabwe. Lots of third world countries have had it. Some big ones have had it. Sometimes it's a political revolution. Happened with Mao. Happened with the Russian Revolution. But you have a currency event, and the currency fails. I mean, I find it interesting. I talk to a lot of people from South America. 'Cause I'm in the mining investment business. So I talk to people from Argentina and Peru, and they kind of get it because their currencies have all failed multiple times.
Oh yeah, it's not academic to them. They've got
No,
it
it's
in their
real. I
lived
mean, they
history.
talk about. I had a guy talking to me about how his parents, used to get paid, and they'd literally go to the supermarket right after they got paid to buy the food, or else they weren't going to eat that week. And
So I talked to a guy from Argentina who said the same thing, but he said the trick was you had to get to the supermarket and see where the guy with the sticker gun was. Because like twice a day he'd go update prices.
had to
So
run in
you'd want
front
to
of
be
him.
ahead of him to get
Yeah,
to the
yeah,
can
yeah.
before he
Before the
put
new
the new
price came.
sticker on it.
Right.
Yeah.
Yeah. Isn't that some? Yeah. So we haven't had it at a reserve currency level in kind of maybe like forever, unless you want to argue the Roman denarius failing was a reserve currency. But yet, I like to say, pursue emerging market policies, get emerging market results. I mean, right? And when we're pursuing all the same policies, we're spending more. We're at the point now where we're printing money just to cover the interest. I mean, that pretty much does it, right?
Have you ever seen that acronym? It's sort of a meme, FAFO.
Fuck around. Yeah, 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 yeah,
Yeah,
yeah, yeah.
yeah, yeah. F around and find out.
Yeah,
Yeah,
right.
maybe that should be changed to fiat around and find out.
I
Right?
think that's about right. I mean, it's the same. Yeah, it's the same idea. Yeah, the other acronym I really love is NTST. When nothing stops this train. I love
Yeah,
that
yeah. The
line of
whole Lynn
thinking. I mean,
Alden. Yeah,
because it really does seem to be. I mean, the political system. I mean, it's funny. I mean, one of the problems is that when they set up Social Security, they thought people would, people were dying in their 60s and 70s. Of course, we're now all living to our 80s and 90s, and we have all expensive health care. And, so the boomers are going to get screwed on their Social Security because it's just not going to buy as much as they age. But, and it's the third rail of politics. They can't touch it. But effectively, they're really going to get screwed in the sense that they're going to lose. Okay, so you're not going to cut Social Security, but you're going to cut the purchasing power of what you get from Social Security. So you get to the same place, right?
so this is a whole other thing we could talk about that we just don't have time to derail in it. But I've been talking a lot about this recently, where yes, there is going to be a big wealth handoff from the boomer generation to their children.
Yeah.
But I'm going to take the under on it because I think a lot of that is going to get lost in the decline of purchasing power and
Totally
how far medical, end of life medical care costs and assisted living and all
Totally
that.
agree. Yeah,
Yeah.
totally agree. I mean, and it's really sad. And that's what's so great about sound money. I remember very clearly watching my dad, who retired with a very respectable amount of money for a Midwestern businessman, and I just watched him kind of run out of money slowly over time as the inflation ate away at it. Do you know what I
Yeah.
mean? And by the
It's
time he
interesting how
passed,
that drives a lot of us. I saw the
yeah, I mean,
same thing
I
with
don't
my
want,
mother. Yeah.
I'm 68, and at some point I really do kind of want to stop working. I don't want to run out of money, And so you save money, and it's kind of like, okay, what can I save in so that it doesn't get stolen from me by inflation in the
Yeah.
future? It's a real issue.
All
Yeah.
right, my friend. Well, look,
Well, thank you.
let me start to land the plane here.
Okay.
One more sort of major question, then some wrap up ones. Just do you have a general market outlook from here? Markets are obviously richly priced at the time we're talking about here, and we've mentioned that the economy is slowing, and that tends to not be a great cocktail for future
Yeah.
asset prices, but I don't want to lead your answer. And secondly, do you have any sort of recommended positioning at this point in time, given your market outlook beyond the sound money assets we've talked about?
I don't. I mean, I'm kind of a bear on the stock market. I don't think it's particularly cheap, but these bubbles can go on longer than you think, and maybe we do live in a new monetary world where there's going to be a crack up boom. I mean, I think people who own stocks in Venezuela and Weimar, the stocks, like if you own stock of Mercedes, it's in the book. If you own stock of Mercedes Benz, you went through the Weimar example. You hold on to your certificates. They've reset into a new currency, and that stock ultimately had value because Mercedes Benz was a useful enterprise, right?
Mm-hmm.
So stocks kind of protect you. So I'm not terribly down on stocks, but I just don't find these values compelling. I mean, the only compelling values I see in the stock market are internationally and in commodity-based businesses and in the gold and silver miners. I'm gonna have to put in a pitch for that. I run a fund that specializes in those, and Until very recently, I had a lot of companies trading at 2 or 3 times EBITDA, and for those who are financially driven, that's cheap. You know, I mean, Google is selling at 20x EBITDA, so you know, those are up a good bit. So the first 2 innings are over in the bull market for that stuff. So I'm pretty bulled up on, you know, gold, silver mining stocks, what they can do. You know, I know your guys, you know, Landra and the guys you work with are in the same position.
The New Harbor guys, I know you're
Yeah, the
referring
New
to.
Harbor guys. Yeah, I mean, I don't know. I mean, I have a lot of people. I know a lot of people are really married to their stocks, and you know, look, owning a great company for a long period of time, there's nothing wrong with that. You know, if I were looking at getting into the stock market right now, I'd be, gosh, it's not cheap. You know, I'd much rather buy it, you know, when there's blood in the street.
Yeah.
And, you know,
Let me ask you this on the miners. Do you
yeah,
feel that they have caught up to the metals in terms of their expected price
that's a great
movement?
question. So the miners were just grossly undervalued compared to the price of the metal. And what was going on there was people were thinking, well, this metal move isn't real. You know, gold's going back to 2000, and therefore the miners are properly priced. And maybe they were priced. They weren't overpriced at 2000, but maybe that was they were at a fair price at 2000. Of course, now with gold at 3500, you know, the margins just have exploded. The profits have exploded. And so you're buying them at very low multiples to cash flow. And you know, the Huey, the XAU, GX, I mean, most things are up about 85% this year. My fund's up about the same amount, almost 90%. And so yeah, we moved off the bottom and we've started to close. It was really an alligator jaws, as you can see on the chart. And so we moved off the bottom, and what you can see is that the Huey is catching up to the price of gold. But I always said, and I do believe this, that you know, we're now just getting to the low end of the range of fair value. And typically in bull markets, you tend to go to fair value or a little beyond, and that's, you know, the low end of the range of fair value, maybe at $3,000 gold. And if we're going to $5,000 gold, well, then fair value is going to get even higher. So, you know, handicapping where we are in the gold market, my personal opinion is if this is a 9-inning baseball game, we're in the 3rd inning. You know, we're in the top of the bottom of the 3rd, and you know, we got a few more innings to go. I mean, some people would say, I think I heard Luke Groman, I heard somebody say we're in the second pitch of the 2nd inning. I can't remember. It was a podcast. Somebody said that
That's
recently.
pretty specific.
Yeah, I was like, wow, really? I think it might have been Luke Groman who said that. I mean, it's really early. I don't know. I mean, I don't. You know, these things have moved, and you know, they're not. I'm not getting the bargain prices. I mean, a year ago, I was just like, I can't believe this. I mean, I can buy this company. It's growing. It's profitable. I'm paying 3 times cash flow. What? You know, it's just, this is nuts. How do I have this opportunity? It was just because people didn't understand it. Well, that company's now doubled in value. So now I'm paying 6 times cash flow. But cash flow is going to go up a bit. And, you know, even 6 times cash flow is not crazy over expensive. I mean, at the peak in these gold and silver stock mining runs, they get up to 15 or 20 times cash flow. Now, that's expensive. But, you know, so multiples do expand in a bull market. But of course, margins will expand if the metals keep running. So we've got a bit further to run at them. I'm very comfortable buying them here, and I'm very comfortable. I'm still taking new investors here. I took a bunch of new investors at the top, and in 2019 I went up 97%. In 2020 I went up 123%, and a bunch of new investors came piling in. Oh my God, this is the greatest thing since sliced bread. I got to own this thing. Da, 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 da. And then I rapidly went down 40%. You know, and they're like, "You're an idiot." You know, why did I put my money with you? And I'm like, well, you know, if you have a long-term time frame, you're going to be okay. But obviously, not everybody could see that, right? And so I'll probably, you know, when we go up a little bit further, I might say to new investors, no, I'm not going to take you in at this level because you know, there's a chance we'll have a correction, and I don't want you to be unhappy. So.
All right. Well, Larry, if someone's interested in learning about the fund, where should they go?
Oh yeah, so you can go to ema2.com, edwardmarkalpha2.com, or Google Equity Management Associates, which is the fund. It's run by myself and David Foley. And then the other, kind of for a real time, we have a quarterly report there where you can see our macro views and fund views and our strategy. It's free. You can sign up for a free newsletter. Just go down the bottom of the page. You can insert the email there, and we won't spam you. You'll get the newsletter every quarter. And then probably just on a real time basis, the best thing is just follow me on Twitter, because I'm pretty active on just kind of talking about things. And occasionally, you know, for those who are looking for like, what's your favorite silver stock right now, or you know, what name should I be buying? You know, I leak out gems there for free on Twitter. Like, I love this stock. I mean, actually, I'm just looking at one. I'll give you one now. Here's a silver stock that hasn't moved that I absolutely love. I think it's really cheap. It's Southern Silver Exploration. SSV.VC. The US ticker is SSVFF. These guys have a ton of silver. They're in Mexico. It's very safe. It's a good management team. and nobody knows what it is yet. It's still cheap. So it's got a 60, no, it's got a $617 million. Make sure I get this right. Yeah, it's a modest market cap for what they have in terms of the amount of silver they have. So, yeah.
All right. Well, fantastic, Larry. When I edit this video, I'll put up the links to your website, to your ticker, your X handle, so folks know where to go. I'll also put up for the ticker for that silver company.
Silver, yeah, and I'll get you the chart on the comparing the two, the Huey to.
Great.
Yeah.
Great. Yeah. I very much appreciate you sharing the ticker. That was a nice little bonus.
Yeah, I figure what the heck. I mean, yeah.
Well, very importantly, we've referenced it enough during this discussion, but and I was looking for my copy and couldn't find it right before I had to jump on here. I'm sure I see you got a stack behind you there. There we go. So for folks that would like to get the big print, where should they go? Is it just anywhere books are sold?
It's just Amazon. I don't have a professional publisher yet. It's a little bit edgy. Like Richard Warner, who couldn't get Princess of the Yen published in the U.S. I've been getting turned down by publishers. I don't think they like the message. It's not Fed friendly, as you know.
Have you told them it's burning up Capitol Hill?
Well, yeah, it is. I haven't told them that, and I've sold 40,000 copies of it. So it's which is I hear that's okay. I mean, I don't,
that's pretty darn good. As a guy who's co-authored a book that sold over 20,000, I know that 40,000 is actually quite good.
Yeah, there are 300,
especially independently,
people here, so we got a long way to go to educate everybody. But it's on Amazon. It's all formats: hard copy, paperback, Kindle, and audio. So, yeah, I mean, obviously, and as you know from doing books, you don't really make much money on books. But what got me into this, Adam, I had an early potential editor. I was speaking to her, and she said to me, she said, Larry, books can change the world. And that was just like, she just sunk the hook. I was like, okay, all right, I got an ego. I want to write a book that's going to change the world, because I looked out there and I saw that all these people are getting hurt by inflation. They don't understand why, and they don't understand how to protect themselves, And so the book is aimed at really trying to solve that problem. Point out why. Part one is why they're getting hurt, and part two is what they can do about it.
Yeah, I think a great thing that your book does, Larry, is I think the average person can feel it in their guts that their money is just buying less over time. They're just feeling like the headwinds are getting stronger and stronger, but they don't necessarily know why. And on this channel, I talk an awful lot about the failure of our education system to teach financial literacy, right? Yes. Your book does a great job of just pulling the veil from like explaining it to them in an intuitive way that they can take it and understand what's going on. And then, to your point, it's not just problem definition. It's, hey, here's what you individually can do about this.
Exactly. And if I help some people, well, then, it's my legacy, and that was the goal. So I hope it works.
Well, I'm so glad you did do it. And again, for the folks that didn't get your book after your first appearance on this channel, folks, highly recommend you go get yourself a copy. So go to Amazon. All right. Well, look, as we wrap up here, Larry, I'm looking at the time. You went real late with me. Thank you for being so generous with your time.
I really enjoy it. You're one of the best in this business, and so it's an honor to be on your show.
Well, it's a real pleasure. Folks, please let Larry know how much you appreciate him coming on by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. All right. Well, in wrapping up here, first, if you are looking to get some help in figuring out how to invest for the type of future that Larry sees ahead, especially if we continue going through this fourth turning, and if Lacy and Steve Hanke's outlooks for disinflation, perhaps even deflation, lie in store for us in the near term, at least. And obviously, we've got the purchasing power concerns that Larry and I talked about in great depth here. If you would like to get some help in figuring out, okay, how do I navigate my wealth through this type of short-term and longer-term and future, where hopefully I don't become a victim of these trends, and I might even be able to position to profit from them, then highly recommend most of the people watching this video get that help from a good professional financial advisor, obviously one that takes into account all the macro issues we talked about here. If you've got a good one who's doing that for you and has a good record of executing on that plan for you, great. Don't mess with success. You should stick with them. But if you don't, or you'd like a second opinion for one who does meet that criteria, they consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. You heard Lawrence reference the guys there from New Harbor Financial. So to set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved to work with these firms. It's just a free service they offer to be as helpful as possible to as many people as possible. Also, don't forget that we are still making tickets available for the upcoming Thoughtful Money Fall Online Conference, available at the early bird price discount. That's the lowest price we're going to offer for this. Again, the conference is on October 18th. So that's a Saturday. If you can't watch live that day, don't worry. Everybody who registers is going to get replay videos of the entire event, all the presentations, all the live Q&A. The conference faculty is amazing. It continues to get better. And I'm, I think, revealing this for the first time publicly. We just had Lynn Alden commit to come on, and she's going to talk specifically about Bitcoin. We're going to do a deep dive with her on Bitcoin. As Lawrence mentioned, she's one of the best experts, best known experts out there on the topic. We'll have some other guests talking about gold and silver, but we're going to reserve this slot for Lynn to really go deep into what's going on with Bitcoin. So if you would like to lock in your early bird price discount, go to thoughtfulmoney.com/conference, register today for it. Also, a reminder, if you are a subscriber to the Thoughtful Money Premium Substack, make sure you check the emails you've got from me. I've sent you the promo code to use to get an additional $50 off of that early bird price discount. All right, Larry, again, can't thank you enough, my friend. It's always great to talk to you. Really appreciate you giving us so much time, especially on a Labor Day, and look forward to seeing you again on this program soon.
Thank you. Nice to see you.
All right, and everybody else, thanks so much for watching.
Same time U.S. declares silver as a national priority, you have Saudi Arabia buy a bunch in SLV. You see India's demand of silver is up 431% year over year in May, and record ETF inflows in June despite higher prices. So yeah, I mean, there's a lot of demand for physical metal that hasn't translated into the retail side of it yet. But the rest of the world, the big money, whether it be on the exchanges or the central banks or the sovereign wealth funds, are making it very clear that silver and gold are quite significant, and platinum, to their plans.
The U.S. has officially declared silver a national priority, signaling its rising strategic importance. At the same time, global demand is surging. Saudi Arabia has been buying large amounts through silver ETFs. India's silver demand jumped 431% year over year in May, and June saw record ETF inflows despite higher prices. While retail demand hasn't yet fully caught up, institutional investors, central banks, and sovereign wealth funds are clearly positioning silver. Andy is a well-known precious metals expert, CEO of Miles Franklin Precious Metals, points out that a large amount of gold and silver has recently flowed into COMEX, with September deliveries hitting 267,000 ounces of gold and 42 million ounces of silver, an unusually high figure. At the same time, short positions in SLV are surging, signaling major moves behind the scenes. The recent BRICS and Shanghai Cooperation Organization meetings also highlighted a geopolitical shift. Trump's threat of 50% tariffs on India seems to have backfired, since U.S. trade only makes up less than 3% of India's GDP. This is why leaders Xi, Modi, and Putin demonstrated unity at the SCO summit. Andy highlights that the SCO is not a minor group. It represents over 40% of the global population, 35% of global GDP, and nearly a quarter of the world's land area. Modi emphasized India's strategic autonomy, making it clear they will not sacrifice long-term interests. Meanwhile, China is investing in mandatory AI education from primary school upward, preparing its youth for technological dominance, while many Western youths focus on social media aspirations. This difference in priorities, combined with U.S. policy missteps, risks leaving America behind. Adding to that, U.S. stock valuations are now at record extremes, higher than even during the dot-com bubble and Great Depression, with investors heavily leveraged and exposed. Insiders appear to be exiting while the public piles in. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
A lot of gold and silver coming into the market, into COMEX. So far for September, 267,000 ounces delivered. 42 million ounces of silver delivered, which is huge. We talked about the shorts are up big time in SLV, which is huge. We talked about the BRICS meeting, the Shanghai Cooperation meeting. I think what I take away from that is that Trump overplayed his card with India, threatening 50% tariffs. When you look at the actual numbers, even though we are their largest trading partner, arguably, it only accounts for under 3% of their GDP, their trade with us. You look at a country like Mexico or Canada, where it's the majority, that's different. We'll have greater weight. The purchase of Russian oil for India is far, far more important to them. And this is why you see Xi and Modi and Putin shake hands and smile and hug at the Shanghai Cooperation meeting. The SCO is no small organization. I've talked a lot about it on your show. It's over 40% of global population, 35% of global GDP. 24% of the land area. And so when you talk about takeaways, I think the fact that Modi stresses strategic autonomy, will not trade long-term interests for short-term appeasement. And, they're making stronger ties with Russia, with energy and defense and security. One of the things that I found interesting was that China is now embarking upon mandatory AI education from primary school, building all the way up through high school to build a AI talent pipeline. And so I found that to be very interesting. I also found it interesting that of all of the Gen Zs polled, that the number one job that came out on top wanting to be was a social influencer. And yet you have all of these kids in China that are becoming engineers and astronauts and becoming proficient in AI from elementary school on. These are the things we're getting left behind, whether it be in the way that our kids are being raised with education, or what's happening in our U.S. foreign policy missteps under the Trump administration. As much as I would vote for him again, I think he really overplayed his hand with a country like India. And, I think that these are the kind of mistakes that are going to have ramifications with the continuing emergence and strengthening of not only the Shanghai Cooperation Organization, but the BRICS. We have not heard the end of that yet, but I found it interesting that more or less Modi came out and said, we're not going to back down from our relationship with Russia and or our oil purchases from them. It's more important than just about anything right now. So how this all plays out, I guess we'll see. But putting 50% tariffs on India was, I think, a big misstep. And that's what I took out of the Shanghai Cooperation Organization meeting. Other than that, like I said, likely to see payrolls be revised. I've read from anywhere from 500 to 800,000, which they will use to justify rate cuts. But when you have U.S. stock valuations now at the most expensive in history, surpassing the dot-com and pre-Great Depression levels, you got some serious risks ahead if indeed they do this, as the public is all in on equities, all in on margin, all in highest ever, and all in on options exposure highest ever. That's a dangerous market as the insiders are moving this way, the other way. So I don't know. It's not too much happened that is off the charts this week. I'm sure there will be by next week, but just more continuation of the same.
Andy explains that 8 major Western banks hold the largest concentrated silver positions ever seen on COMEX. This isn't just about controlling price. Though prices have been deliberately suppressed, it's mainly about maintaining access to silver stockpiles. Silver is unique because even tiny amounts are critical in high-value products, from cruise missiles to iPhones, so availability matters more than price. Rising prices would attract investor demand, but there isn't enough supply to meet it, which is why the market has been manipulated. Now, however, silver is recognized as a truly strategic metal. Although silver has risen to around $42 in mid-2025, a level many would have celebrated a year ago, analysts say this is just the beginning. With global players like Russia, India, Saudi Arabia, and China aggressively buying, and U.S. demand on COMEX also surging, the market is tightening. Once the retail side wakes up to this reality, shortages could spill over worldwide, and that's when silver prices may truly explode. For now, it's still an opportunity for early investors before the real fireworks begin. Now let's dive into the interview.
Banks, and I'll talk about Ed Steer's chart again that you showed several months ago. When you see 8 Western banks that maintain the largest concentrated position of any commodity ever traded on COMEX, it's not to hold down the price. Well, it is, but it's not price that's bothering them because silver is inelastic. You don't need a lot to make a very expensive item. Even if it's 500 ounces in a Tomahawk cruise missile that costs millions and millions of dollars, or a fifth of or a sixth or eighth of an ounce in an iPhone, the cost of the finished product is so much higher than the little incremental price of silver. It doesn't matter. More along the lines of they've tried to step on it because rising price would attract demand. And there's not enough availability of it. The price has been skewed by the trading on COMEX and the LBMA. It's real value skewed. And so I think the rising price would attract investors, speculators. They don't want that. It's more along the lines of being able to access stockpiles of silver rather than the cost of the silver. I know that sounds kind of strange, but if you're making it for all of these critical components, it's less about the price and more about the availability because it's used in such small amounts in whatever the finished product is. But you're right. It has been suppressed. It has been held down. It has been manipulated. And I think now there's a race to accumulate it because indeed it is strategic. It is critical. It is needed not just in electronics and electrical components, just about anything that conducts electricity. It is needed in military components. It is needed in medical devices. It is needed in so many places, solar panels, etc. And that plurality of demand, from monetary demand to military demand to industrial demand, makes it strategic, every bit as strategic as any of these other strategic metals. And I think that's the change, is that Trump understands that, his administration understands it. So, this is something I think that will continue, and there will be at some point, I see a battle between the industrials and the, or shall I say, the manufacturers, the producers who need it, and the investors. So you're going to get companies like Tesla and Panasonic and Sony and whatnot in a battle for what's available. As the hedge funds and the investors start to take the other side, they're going to battle, and it's about availability of a depleting asset. It's not as much about the price, but just about the availability. And you start to wake everyone up just like that. It disappears. And what is a shortage on COMEX spills into a shortage globally across the board into retail as well. Not there yet. There's still great values, but I see that happening as where this ultimately goes to. But if I would have told people, a year ago that we'll be staring at $42, in early, mid-2025, I think most people would have been happy about that. Quite frankly, I think it's just beginning. We're a long ways away from seeing where this ultimately stops, but this is where it should have been a long time ago, and I think it's still got a lot of room to run based upon everything that I'm seeing, whether it be anecdotally or economically, or just by the movements of the biggest players in the world with Russia and India and Saudi Arabia and China. They're all gobbling up silver as fast as they can. Evidently, so are the folks in the United States now, too, at least on the COMEX. When that translates to the retail side, which I believe it will, something will wake up the public, that's when we'll see real fireworks. And, of course, we're not there yet, but that's a benefit to all of you who are trying to add to your portfolio before the prices get out of hand.
Silver's transformation from a quietly suppressed asset to a recognized strategic resource marks a turning point in global finance. With record institutional accumulation, geopolitical realignments, and growing industrial needs, the foundation is being set for a historic silver bull market. The window for early positioning is narrowing, as both governments and major investors move ahead of the public. How soon could retail investors begin to feel the global silver shortage already affecting institutions? Could U.S. policy missteps accelerate silver's role in a new multipolar financial system? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.
The purchasing power of the dollar has fallen 99%. Those are the numbers you're saying. 99%. The dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce. And that was from, 1856 or something. And it was... it was de facto, but then it became de jure with the Gold Act in 1900. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs, pushing up prices, if you like. That's so much like Germany between 1922 and 1923.
Although the dollar's decline began earlier, it has already lost about 99% of its purchasing power since it was separated from gold. Deutsche Bank has explicitly warned of a crisis of confidence in the US dollar, suggesting that shifts in global capital flows might overwhelm usual currency fundamentals, causing erratic moves. JP Morgan says the dollar's long bull run is ending, with an expected 10 to 20% medium-term decline against the euro and yen. They see this not as a collapse but as a gradual reset. By 2026, increased tariffs and a failing dollar might cause prices to rise, a scenario similar to Germany's inflation crisis in 1922 to 1923. The dollar has lost around 99% of its value, albeit the slide started earlier. The 1900 Gold Act established that $20.67 would purchase 1 ounce of gold until 1934. Now, in mid-2025, JP Morgan warns that U.S. tariffs, trade policy, and slowing growth could lead to stagflation. They lowered their U.S. GDP growth forecast for 2025 to 1.3%, from 2%, owing to tariff impacts. They also expect foreign demand for treasuries to decline, which weakens one pillar of dollar strength. The International Monetary Fund (IMF) has also flagged that recent U.S. tariffs could add inflationary pressures and warned of weakening domestic demand and slowing job growth. The Roaring Twenties and the 1929 crisis were both exacerbated by Hoover's tariffs and the Fed's credit expansion under Benjamin Strong. Now, the risk is much higher and might destroy the currency due to Trump's tariffs at the height of a huge debt bubble. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, basically, what you've said it all. I mean, the purchasing power of the dollar has fallen 99%. Those are the numbers you're saying. 99% since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep.
And President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. Yeah, I mean, basically, no. We used to have a phrase, which I don't hear nowadays, about kicking a can down the road. People, I think, sort of think, whoops, I don't think it's, they start talking about a reset and, all this sort of rubbish. I mean, the fact of the matter is that the Fed has got no control over the situation. And it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And, I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. I mean, this is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War.
Right.
I mean, Hayek actually put this very, very well in his Road to Serfdom. He sort of had a bit where everybody starts saying, we need a strong leader, to get us out of this mess, because they'd had enough of the weak politicians who screwed us up. We need a strong leader. And what did they get? They got Hitler.
Germany experienced 3 stages following World War I. The first, from 1918 to 1920, saw the mark lose roughly 80% of its value, akin to the inflation that followed the COVID-19 pandemic. The second, from 1920 to 1921, saw a brief improvement as the mark strengthened, business resumed, and optimism returned. And the third, from late 1921 to 1923, concerning parallels can be seen in the U.S. today. Officials are publicly pushing the dollar lower, markets have soared, and bond yields are still high. Only short-term T-bills are in demand, as foreign investors are shunning long-term treasuries. The dollar may plummet if bond yields increase while the Fed lowers interest rates. When tariffs are added, we may witness a crumbling dollar and skyrocketing prices by 2026, akin to Germany's hyperinflation. Since exporters benefited, politicians and business groups at the time even favored a weak mark. Similar to this, current policies run the risk of devaluing the dollar's purchasing power even while they may benefit certain groups. Let's dive into the interview.
Yeah, we're not quite there yet. I mean, you mentioning the, Adam Ferguson's book, When Money Dies, and all the rest of it, actually hits the nail on the head. Because I put out a note, I think it was a few days ago, which looked very, very carefully at what happened in Germany between 1918, which was the end of the First World War, and 1923. And there were 3 phases. The first one was between 1918 and 1920, when the purchasing power of the Reichsmark fell about 80%, something like that. So, this was a nasty situation. Now, this is actually quite like what happened following the COVID shutdowns.
Right.
And then we had this inflation, which meant that the purchasing power of the dollar actually fell. Not as much as 80%, admittedly, but it fell quite sharply. And then what happened in Germany from around about February 1920 to December 1921 was suddenly things improved. And the Reichsmark actually went up against the dollar, which, remember, was on a gold standard, on a proper gold standard. You could exchange your dollars for gold at 20.67 to the ounce. So the Reichsmark was strong. Businesses were recovering, if you like, from the shock, the post-war shock. There was a certain amount of tourism going on. I mean, things were really humming. The stock market tripled. Everybody thought, this is absolutely wonderful. We've got over this, etc., etc. But then there was a crash. I think the stock market lost something like 25% in the December of 2021.
So 1921.
between 1921, end of 21, in other words, through 22 and 23, what happened was that the purchasing power of the Reichsmark began to collapse. And the collapse was total. Now, so far, we've had the post-COVID thing, which led to inflation, and now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200 in 1922 to where we are now, which is 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
right. That's the bad news.
This is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. They are going to destroy the dollar.
Yeah.
The foreigners so far and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining. Now, on top of that, what do the foreigners do? Well, everybody, including the large institutions, stand back and they don't buy treasury bonds. Certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. They're going to have to reverse that. Or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect. But it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs pushing up prices, if you like. And, that's so much like Germany between 1922 and 1923. So the next question is, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics. Because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. It was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it.
The warning signs are obvious, and preparation is crucial, regardless of whether the dollar experiences a similar fate. Will authorities intervene before it's too late? Or do you believe the United States is on the verge of a disaster akin to Germany's collapse in the 1920s? Should the dollar really start to depreciate by 2026, how should investors position themselves? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump-and-dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening. So Asian trading has just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday. Silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast. When Donald Trump gave his first speech as president and announced the golden age in America, I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year, right? Gold is killing it. In fact, Bitcoin is 13% below its peak, right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? Because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. Maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price, but he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's, you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But no, gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.